Peace, family. Peace, peace. Make sure y'all hear me. Can y'all hear me?
Yes, I can hear you.
Good,
Glad.
good. How y'all
Yeah, I
doing?
can hear you.
Yeah, I can hear you.
Yes, I can hear.
Good, good. How y'all doing this afternoon?
Doing great. Thank you. How are you?
I'm good. Can't complain at all. Can't complain at all.
Awesome.
So we're gonna get into technical analysis tonight. I know a lot of y'all probably couldn't wait for this one. Um, so for the past week, last week's class, we basically introduced y'all to the charts, letting y'all know, how to read the charts as far as where to go to get your charts first, tradingview.com. Obviously there's other websites that you could go to, but tradingview.com is pretty much where I'm at every day. Also, um, just getting you familiar with it on a level to where I can start talking to you through the charts. So from now on, if you guys ask me my opinion about a specific stock or my opinion about, an entry or price target or anything like that, I'm going to do the analysis straight through the chart. I'm not going to send you screenshots or anything like that from my Robinhood account. I'm telling you this and that. I'm gonna pull up the chart. I'm gonna probably video it, and then I'm gonna send you the link for it. And or if I do send you a screenshot, it's gonna be a screenshot of the chart. I need you guys to start reading the charts when you're getting into this because it's gonna put you and keep you at an advanced level. Um, Robinhood, is a beginner's app. You're limited with what you can do there. There is a way that you can look at the chart on Robinhood. If you have like an iPad, um, I'm not really sure about the desktop, but if you have an iPad, you can look at the charts on your tablet or whatever. But as far as like getting into this stuff on a deeper level and really reading the candles and switching stuff up and putting, indicators on and doing the things in a way to where a professional can do it, you want to get to a website like TradingView. So I use TradingView separate from my actual brokerage accounts. I have TD Ameritrade. I do use Thinkorswim, but I don't chart on there. I chart on TradingView. And then I'll go and I execute my trades on the actual brokerage platform. So you don't have to do it that way. I'm just telling you what I do. It's easier for me that way. So um, I wanted to ask y'all questions to make sure that you understand everything as far as where we at right now. But I'm gonna go through here just so y'all know, how to maneuver on this site. So again, last week we went over everything as far as introducing you to what it is, and hopefully you had some time last week to go through it and play around with it if you were unfamiliar. But we're gonna get into the technicals today. Um, Before we get started, is there anybody that has any questions about any of the stuff that we've been going through these past few weeks when it comes to options, executing, anything dealing with Robinhood, anything dealing with um, getting in and out of a trade, spreads, whatever the case may be? Any questions, go ahead and ask them now so that we can just get into this technical stuff, and then we'll have questions about the technical stuff after. So if you have questions about anything that doesn't involve technical stuff now, go ahead and ask them. You can raise your hand in the raise your hand and then I can get to you, or you could type your question in the chat and I'll call on you and you can unmute yourself. If anybody has any questions, go ahead.
I have a
Everybody good?
question
Okay,
first.
go
This
ahead.
is this is Natasha. Thank you for allowing us to ask that. I just have a question about the spread. If you
Hmm.
could review that quickly. I know that means you're doing a put and a call at the same time. Is that right?
Nah, so when I mention spread, I'm talking about the difference between the price that you're willing to pay and the price that the seller is willing to sell it to you for. So a lot of people was having issues last week and the week before when they placed the order and the order didn't get filled right away. So if your order doesn't get filled right away, 9 times out of 10 is because the spread is too wide. Also, people might come in and they try to sell something. So like they already had an option contract and they woke up in the morning or the market opened and it just skyrocketed. They see a lot of profit. They're trying to hurry up and sell so they could get their profit, but the order's not executed or it says
Yeah, that
pending.
happened to me. That happened with me with Sundial, actually, exactly
All
what
right.
you're talking about. So that's called a spread.
Yeah, so what happens is, let's use this for an example. Let's just say I got this one, right? So if I wanted to buy this right here, you see this limit price right here where it says
Yes.
limit price,
Mm-hmm.
184 and 185, right? This spread right here is nothing. So I could type in 185 or I could type in 184 and my order will probably get executed immediately. But sometimes, usually when the market opens, when it's at its most volatile point and the prices are fluctuating so drastically within a short period of time, these spreads are going to be so wide that it's going to be really impossible for you to get your order filled because it's such big of a difference between the seller price and the buyer price. So when you're buying, the lowest price is going to be, obviously your price. The highest price is obviously going to be the seller price. If you want your order to get filled immediately, then you need to be on the side of the seller more than the side of the buyer. So the price is going to be higher. Basically, you want to get it. If you're trying to buy, you want to get it at the highest price possible. Now, obviously, that means you have to spend more money, but there's a higher likelihood that that the seller is going to actually let that order go through. So you see what I'm saying? So if I could see it, let me see if I could get a better example. Maybe Tesla. Do you understand that?
I do, especially because it happened with me with Sundial, so it was making perfect sense. My order would not fill when I first tried to sell it that morning because the price had skyrocketed and it sat there for a while. So then I had to go in and decrease it, if that makes sense, like what you're saying, in
Yeah,
order for
exactly.
it to execute it.
Exactly. Yeah. So basically what I did was, and I instructed people, if I'm trying to get in or out of a trade and I'm trying to execute something, I don't leave that screen until I see that the order has been filled. I literally keep it on that screen. I don't exit out. I don't click nothing. I don't do nothing. When I execute the trade, I'll sit here and watch it and I count to myself 5, 4, 3, 2, 1. If it doesn't get executed, I'll cancel the order and then
Okay.
I'll replace it and change this limit price, adjust
Okay.
the limit price. And you'll see that the limit price will be moving around as you're
Mhm.
trying to push buttons. It's because the price is fluctuating so much. Everybody's trying to do the same thing. So
Okay.
you see this price, you see the spread between this price is bigger than the one that we just pulled up last with Apple. All right. So this particular example right here is a little bit better, but you can see that you want to be somewhere in the middle to where it's good for you and it's good for the seller at the same time. But if you don't want to leave it up to chance, best thing for you to do is just go ahead and get it close to the highest point as possible, and then your order will get filled down there immediately.
Okay. Thank you. It makes sense now. Thank you.
All right, no problem. Let's see who else we got. Simone.
Hey, what's going on, Mel? My question is the difference between the when you're using the options profit calculator,
Mhm.
how do you decide whether you want to be in the money or out the money, whether or not you're doing a put or call? That is the part that's still confusing me.
All right.
Because if it's something I'm trying to research and I do it on the options profit calculator, I know that you stated that it'd be a slight difference in what you see on Robinhood as to what you see on the options profit calculator. But I think for me, I can only speak for me because I'm just beginning. I'm trying to get in a position where it's going to gain me the most money. And sometimes a put will get me money, but I'm still trying to figure out how to pick which is going to be the best option to go with. Because most of mine have been long call, bullish calls because I'm still learning.
Yeah.
But a lot of them for my budget are never like quite in the money, especially when you do this chart and you write on there out the money, in the money. I'm
Yeah.
like, I'm never in the money. So it's kind of hard for me to figure out which way to go.
Okay.
Utilizing the option profit calculator.
Okay, so first of all, if I'm looking at an option and I'm saying, okay, like in my account right now, okay, I got $885.67 in buying power right now. I can't afford none of this. You feel what I'm saying? So it ain't even no point in me trying to go over to the options profit calculator and figure out where I can get in at, because I can't afford it. I'm this ain't for me. You feel what I'm saying? So as far as trying to figure out where your standing is, I mean, we could look at the option. This is February 19th, 8:15. February 19th, 8:15. Wait, where was that? Yeah, 8:15. Boom. So we look at 8:15. All right. And that's the end of money right here. And then this is the actual price, 2170. So I try to find something close to 20. Okay, boom, they got 2170 here. Click 2170. I'm only getting one, $2,170. So as far as figuring out if you're in the money or out of the money, everything that's below the current share price is in the money. Everything that is above the current share price is out of the money when you're looking at calls, all right? When you're looking at puts, it's the exact opposite. So if we were looking at puts, everything that is above the current share price is in the money, and everything that is below the current share price is out of the money for puts, all right? So as far as trying to figure out, what you can afford or whatnot, you say you're usually out of the money when it comes to your budget, right?
Right.
Yeah, so that if that is the case, then that means that you just don't trade that one. That's basically what it comes down to. Even if like we go through stuff in the group and it's like, okay, this is an amazing opportunity. Here's the entry price. Here it is. Here that. Da, da, da. But it all comes down to risk management at the end of the day. Now you're dealing with risk management, because if I have to go all the way up here. If I got to go all the way up here just so I can afford to play, I'm way out of the money.
Mm-hmm.
So now I have to hope and pray that Tesla's price goes from 817 all the way up to 855 just for me to be in the money. Well, there's no guarantee that price is going to go up that high. So I just put myself at a huge risk by doing that. And as soon as I execute this trade, I'm gonna be in the negative. You feel what I'm saying? So you don't want to just grab an option just because you can afford it. If it's out of the money, you're gonna start off in the negative immediately. Then you have to hope and pray that the actual share price goes up past your strike price so that you're in the money at that point. You feel what I'm saying? So you don't want to bet against yourself by just getting the contract because you can afford it. You have to make sure that you are in the money so that you start out in profit, so that it's a better chance of you ending the contract in profit or gaining value quicker, because it's about timing at the end of the day. Yeah, the expiration date is on the 19th. I got a couple of days or whatever before, I think it might go up by the end of the week, but you have to remember when you're looking at the Greeks, time decay, the time is not on your side on this one. You losing $1.50, you know what I'm saying, every single day as it gets closer to its share price. As it gets closer to the expiration date. So you have to be in the money every time. I don't play around with that. When I'm dealing with straight up calls and puts, I want to be in the money every single time. Only time I'm looking at out of the money stuff is when I'm writing contracts. If I'm selling puts or selling calls, like at that point, I'll be out of the money. I'll be out of the money if I'm selling a put, you know what I'm saying? Or if I'm selling a call, I'll be out of the money. But if I'm just straight up buying calls and puts, you got to be in the money every time. And if it's too high, then you just skip over that one and just go to something else.
All right, cool. Thanks for explaining that again. I got a better understanding now.
All right, no problem. Let's see. Sean, go ahead. Sean,
Yeah, no, I was needed to talk about say you got like 100 shares of a stock. How do you put that up for like somebody to buy it from you, or they can write an option with your stock?
all right. So if you have 100, all right, let's say for instance, you have 100 shares of Tesla, right? Then you want to pull up the option chain and you want to click sell and you want to click sell call. Okay. All right. So in this case, you got 100 shares, right? Let's just say, for instance, you bought them. When you bought them at 8.15. So you already making, you already made some profit or whatever the case may be, but you want to sell them. In this case, you want to sell them for more than what you bought them for, right? And you want to say you want to let them go by February 19th. You can be out of the money on this one. Basically, what you're saying is you're going to let these go for $835, right? So you'll select that, and then you got one. So one equals 100 shares, and then you end up getting $1,280 up front because they're going to pay you for the right to purchase those shares at that specific price. This works in your favor because not only are you selling them for more than what you got them for with the strike price here, but you also getting a premium up front. But if the share price goes way up, then you don't get none of those gains. All of that gain goes to the person who is actually buying those shares from you. So if they buy the shares from you at what I select at 835 and the share price goes all the way up to $900, then once they collect those shares, they're going to be in profit way more than you are because they got all them gains. But if you wanted to get that 1280 up front, then you still won, but you took yourself away from getting all that potential gain. You got it? Also,
Okay, thank you. Yeah, I got it.
Also, let's say, for instance, that does happen. That scenario does happen for you, and you change your mind. You can cancel this contract, but you'll have to buy it back. So you'll have to come out of pocket and pay to get out of this contract. And that price may be more or less than what the credit was that they gave you. But if you wanted to take that back, let's say, for instance, that the price shot up and you like, oh man, this joint gonna keep going up. I don't want to give them away for that amount. You could buy them back, and then if you want to write another one, you can. Or you could just keep them. Also, when you're trying to make a consistent revenue stream off of this, you can put yourself in a situation where you can write your option so far out of the money that the likelihood of the share price actually reaching that before this expiration date is very, very slim. So you're basically collecting premium, but you never have to worry about this getting executed because the person that's going to buy it is not going to pay more than what it's worth. So if it hits February 19th and the share price stays at $817 and they already accepted this 880 share price, they're not going to buy it. They're not going to buy them from you. So the contract will actually expire and you just keep the money and you keep your shares. And then you can write another one next week and do the same thing. So that's how people make revenue off of their money. And that's significant for people who are invested in companies that don't pay dividends, like Tesla. Tesla doesn't pay dividends, but you can still make passive income off of Tesla if you use this strategy. You know what I'm saying? All right. Did I answer your question?
Yeah, you answered it.
All right. All right. Who next? Yusuf.
Yes, good afternoon.
Good afternoon.
When researching the company, what should I really be looking for? I mean, it's going to be a lot of negatives there. Like I'm researching HP,
Yeah.
and what's the main thing I should be looking for to say if it's a good company or not?
All right. So mainly what I do, this is a whole bunch of different things you could do, but just to keep it simple, what I do, I use Yahoo Finance because it's so easy. I use Yahoo Finance and I use Business Insider. I mean Markets Insider. But you basically just type in the symbol on Yahoo Finance, and you can look. The first page is going to tell you where it's been at. Now, if you don't want to pull up TradingView and do all that, then you can simply just go here. You know, look at the 5 year. You can see the trend on the 5 year. Look at the trend on the 1 year, 6 months. You know, the previous month. You can see where it's at. You can look at the 1 year target estimate. So basically what they believe that the target is going to be for the year. So right now it's at 27. They thought that it was going to be at 23 for the year. So it's actually above. Some people might look at that and say, oh, it's overbought. Some people might say, oh, no, they're doing good. It's good business. It is what it is. So you can take that for what it is. Also, they'll let you know what the dividend yield is here, volume and all that stuff. Look at the news. The news is going to pretty much give you a gauge on how the public might feel about it. The analysts will feel about it. Also, you can look at the earnings. This is the earnings stuff over here. All right. So these circles right here, these empty circles are the estimates. So what the analysts believe that the estimating earnings per share was going to be. And then when the earnings call comes, the full circles are the actual prices. All right. So the last one, they missed the earnings. The analysts thought that it was going to be higher than it actually turned out to be. So that could be a bad thing, you know, but they already estimated next time that it's going to be higher than the last time. So we'll see what happens with that. Then the recommendation trends, they'll tell you, you know, what they feel like you should be doing, looking at strong buy, hold, underperform, sell, upgrades and downgrades here. So you could look at these companies, Bank of America, JP Morgan, Piper Sandler, Morgan Stanley, all of them have pretty much downgraded this stock. You feel what I'm saying? So people are not really looking to, you know, keep this stock long term, maybe. Also, you can check out the conversations and see what the other investors on this platform are saying about it. You could take that for what it is. Also, always check out the financials, right? So you could pull up the financials and see what the breakdown is for the previous year all the way back to 2017. If we look at that, we could see that 2020, you know, compared to 2019, the gross profit is terribly, you know, a huge dip in profit. And then up until this point, they operating at a negative. So it's not looking too good for HP as far as their profitability. And then you also can come down here and look at, you know, the total expenses, operating expenses. It also has the shareholder, usually should have the stockholder stuff in here. So net income for stock and hold. So that stuff is significant when you're talking about your dividends, right? So if you're looking at investing in this company long-term for dividend purposes, and you look at the financials and it tells you that they operating at a negative and all this stuff as far as the net income for common stockholders is in the negative, then they might be at a situation where they cut their dividend. You know what I'm saying? Because they can't afford, there's no extra profit to pay their investors. You feel what I'm saying? So they're only able to give you dividend payments if there's profit. You know what I'm saying? And if there's no profit, then they might be at a place to where they have to cut the dividend payments. So as far as investing in this company long term, this is the stuff I'll look at. I'll look at the financials. Also, I'll look at the other people who hold stock in the company, just to see, you know, who else is in it and how much they're in it. And then I'll track to see if they're keeping it or if they're selling it, whatever the case may be. But all this stuff is here to help you gauge on whether it's a good company to invest in or not. Main thing you want to look at is you pull up a chart here and you can look at the previous 5 years and you can see that it's just straight up downtrend over the past 5 years. Ain't got nothing to do with COVID. You know what I'm saying? They've been doing down ever since the you know, 5 years they've been going down, and then COVID hit, it just made it worse. You feel me? So past 2 years down, and obviously the past year, it looks like they're trying to work their way up, but look at where they came from. You know what I'm saying? So they got a long way to go. At $27 a share, it has to get all the way back up to $45 and then go beyond that. You know what I mean? So if you want to try to get in here and hope that it might jump back up, you know, you might be betting against yourself, because as you can see over the past 5 years, it ain't been doing nothing but going down.
So I was thinking about writing a call on it. The earnings report comes out in a week and a half.
Yeah.
They say the stock is undervalued.
Yeah, I mean, it is undervalued, but see, like that's another thing too. So when you talking about using the earnings call stuff, right? So what you're saying is you're hoping that it's going to have a dramatic jump in price because they're saying that it's undervalued. But if we look at the financials and they're telling you that they operating at a negative, then when the earnings call comes out, they're probably going to say that they ain't been doing good this past quarter. You feel what I'm saying? So if you want to get a put, then that might make sense. But to bet on them to beat earnings when at the last one they missed it. So you know what I'm saying? It's almost like you betting against yourself. Now, if we pull up the chart, you could look at HP and see what actually happened during the last earning call. So the earnings call is here. Now you see the price jumped up, even though they didn't beat, you know what I'm saying, the earnings estimate. So if you think that's going to happen, then maybe you want to jump into it.
Okay.
But, you know, again, the earnings call is based on the previous 3 months. So, you know, it just depends on how you feel and the information that you get. So what I do is I go through the news and I look at, you know, what the analysts are saying, the predictions, as far as the earnings predictions, you know what I mean? When is the earnings call? That's April 28th. So if you want to invest in this company, I will wait probably, because you got a couple months to go before the earnings call, and just see what happens. You know what I'm saying? Because it's based on the previous 3 months. So let's just see what happens. You know what I mean?
Okay, I thought it was next week.
Go ahead. Go ahead.
Okay, I thought it was next week. I must have read something else.
Yeah. So as far as I mean, it's the date is at April 28th. They can change the date. You know what I mean? Sometimes they change the date, but as far as this website is concerned, April 28th is their earnings call.
Okay.
And they just had it. So 4 days ago. Yeah, so 4 days ago they had it already. So you missed it.
Okay.
Yeah.
All right, I appreciate it.
Yeah, no problem. Who else? Shannon?
Hi, yes, I have a question. I know you talk about, making sure that we're not greedy when we're doing the options calls, but have you ever had an example where you did an options call and by the time the earnings date came, you had made a profit, but you hadn't yet met your target? And then based on the results that came out on the earnings call, the company did exceptionally well and your expiration date had not yet passed. So would you continue to keep that options call and just see how it goes, if you can earn a little more? Or would you try to sell it closer to like the earnings date, by the earnings date, or a little bit after the earnings date?
So basically you saying you started profiting before the earnings call, and then you saw news saying that they was going to actually beat the earnings call, and you trying to figure out if you want to wait to the earnings call to sell it or just go ahead and sell it now.
Yes, correct.
Normally okay, so your price target is your price target. You know what I'm saying? It's all about psychology at the end of the day. If your price target is $150, but it hasn't been reached yet, and all the news that's leading up to it is saying that it might continue to go up, then I would wait until I hit my price target. You know what I'm saying? I will wait until I hit my price target. If the earnings call is a couple days ahead and it's already moving up, I will probably wait until I see what happens with the earnings call so that I'll give myself the best chance of hitting my price target. If you're not confident that it will continue to go up, then that's one thing. But at the end of the day, it all boils down to psychology. It all boils down to how you feel, because the market's going to do whatever the market's going to do. So you can't say, oh, it's going to hit my target. You really don't know if it's going to hit your target. A lot of times what happens on these earning calls is all good news comes out and then the price goes down. That doesn't necessarily mean that people are not confident in the company. That just means they're cashing out. So they could have been in the same spot as you. You know what I'm saying? Whereas you wanted to hold on, but they didn't. They sold, but you still holding it. So you missed your opportunity to walk away with your profit, but everybody else then already came up. So you have to judge that by how big of a price move has it been so far. So if I came in here and I bought at 145 and it already jumped to 150 and I only had it for a day, I'll probably sell it at that point because that's too dramatic of a jump quick. You know what I'm saying? If I got 2 more days left before the earnings call and I already jumped up that high, I'm probably going to sell it because the likelihood of it continuing to rise after the earnings call is very slim, because if everybody got in when I got in, then they're going to probably sell too. You understand?
Gotcha. That's helpful. Thank you.
All right. It's just based on your psychology. At the end of the day, you have to decide what you're comfortable with. If the price has moved dramatically in a short period of time, 9 times out of 10, there's going to be a pullback coming up. You probably want to get out of there rather than hold it and wait to see if it's going to continue to go up. You probably want to take advantage of your quick gains and get out of there. Now, if it pulls back and then you still got some time left before earnings, then you might want to consider getting another call and getting back in on a pullback. But I wouldn't miss out on my gains if you was able to get a profit that fast. I would go ahead and cash out. All right. Heaven.
Yes, can you pull up your chart for HP? I'm trying to figure out why my 250 is, I was trying to see if it was different. I didn't know if it was based on the candles or the line chart, if your 50 and 200 would show different because of it.
No, so what time frame are you looking at?
Let's see. I'm on the 1 day. I guess 1 minute at the top. Are you different?
I'm on the daily.
Okay.
So make sure you're on the daily chart. And then I have the moving average. My moving average is at 200. So MA input 200.
Okay.
And then for the other one, I actually have a smooth moving average. So it's basically the same thing. I can pull up. Let me make sure because I don't want to confuse y'all too much. So I put the other moving average on here just to show y'all the difference. And this is a 50. All right. So you see that it's a little bit different, but I have the smooth moving average in the moving average. So it's SMMA is at 50. But if you wanted to just keep it simple and do both moving averages, one should be at 50 and one should be at 200.
Okay.
But you can see they both cross. It's not that much of a difference. I just like the smooth because it smooths it out. You see this big dip right here or whatever. I just smoothed it out. You know what I'm saying? So the dark green line is the smoother looking one. And then the regular moving average is the one that got more movement, but it's basically the same. There's not that much of a difference. If I scroll down to the 1 hour, you see that it's just more movement in the regular moving average. I just smoothed it out. It ain't that much of a difference. I don't need to do that. I just did it just cause. Not no real. I like seeing a smoother line rather than just jagged stuff. Because sometimes I go all the way down to the 15. You know what I mean? And depending on what stock I'm looking at, it'll be the regular moving average will be all over the place. The shorter the time frame, the more movement it's going to have. So as a lower time frame, like 50, or if I go down to a 9 or 8 moving average, it's going to be more movement. So I use the SMA for the smaller number just to smooth it out, but you don't have to do that.
Okay.
Did you fix it?
Yeah, I fixed it. I just have one question. I might be getting ahead of myself. You see how at the top it has the 5 minute, 15 minute, and then at the bottom it says the 1 day, 5 day. Those are two different things.
Yeah, so you see this
Okay.
little arrow right here?
Mm-hmm.
If you click that arrow, I put stars by the ones that I use the most often. So those are my favorites. So whatever you put a star by are the ones that's going to be popped up here automatically.
Oh, okay.
I don't have to
Okay.
keep scrolling down and selecting stuff. These are the ones that I go to more often than the others. So 5 minute, 15 minute, 30 minute, 1 hour, 2 hour, 4 hour, daily, weekly, monthly. Those are the ones I use the most.
Okay. Thank you.
No problem. Trayshawn?
Yeah, I just had a quick question about the premium. You kind of already touched on it a little bit, but I just want to make sure that I'm crystal clear with it.
Yeah.
So the only way that you can get the premium is if you put the strike price above what you're asking for, correct? Or
You talking about when you selling, when you writing contracts?
yeah, when you're selling.
Nah, so you're gonna get premium regardless. It just depends on how much. So you're gonna get more premium if you write in the money. For obvious reasons, you're gonna give your shares away for less than where it's trading at. They're gonna pay you more money. You know what I'm saying?
Okay.
But if you bought, like, it depends on where you bought them at though, because you might have bought them at $800. You know what I'm saying? You might be willing to let them go for $795 for whatever reason, or maybe $805. You know what I'm saying? You're gonna get more money in premium if you write it in the money call, covered call. You know, the farther out of the money you go, the less premium you're gonna get. So
Okay, that makes sense.
but obviously you still get that gain because you're gonna sell it more for more than what, you know what I'm saying?
Right.
Yeah. Let's see what we got in the chat. Yusef, you got another question?
Yes. Can you put it back on the calculator, please?
Yeah.
When I say calculator like this, I'm thinking it's a no-go. It's more red than green. That's why. Can you explain that to me?
Nah, so like, all right, so sometimes you're gonna see calculators that look like this. Sometimes you're gonna see more red than green. First of all, this is Tesla. All right. Tesla is probably one of the most highly volatile stocks that you could play with. All right. So this price could go to $120. And I mean, hold on. This is Walmart. Let me make sure I got the right one. Okay, so calculate, my bad. All right, so this is Tesla, right? So you see, like, Tesla's price could go all the way down to 700 and all the way back up to 900 in 1 day. You know what I'm saying? So that's one thing. Two, because you're talking about options contracts, so time decay. So the closer you get to the expiration date, the more closer in the negative you're gonna get. So you're losing money. So with this particular contract, this was expiration date February 19th, 8:15. February 19th, 8:15. This one right here, we open it up. Look at the time decay on this. Look, the theta is -15096. Most of the contracts that we've been dealing with in the group, it's been like -0.088 something. You know what I'm saying? Mm-hmm. This is a lot of your profit being taken away. Every single day you get closer and closer to expiration. So when you see the contract looking like this, then you got to go back and see what that theta looking like. Okay. Normally that means that the time decay is eating up your profit. Basically, is what that means. So if we extend it out to March 12th, and we go to 815, yeah, we're gonna pay more in premium, but you know, same thing, like let's go, what was it, March 15th? What was it? March 12th, my bad. March 12th, all the way down to 815. Still high.
Mm.
You know what I'm saying? Like, I wouldn't even mess with that. Now, again, it's Tesla. This joint could go all the way up to $1,000 tomorrow. We don't, you know what I'm saying? It's just so much that could happen. But when you see a chart like this, you really have to have your analysis in order to the point to where you almost have a sure thing, or you know, like, okay, high probability of this thing going up. I'm not worried too much about this. Plus, keep in mind, you have a stop loss too. So you already know that once price hits 804, I'm getting out of there anyway. I'm not too much worried about all this stuff that's going on down here because I'm not going to allow myself to take on any of these losses because once price goes to 804, I'm getting out anyway. You feel what I'm saying? You want to look at stock price range. So if you don't plan on being in this thing beyond 804, then you can lighten up your eyes and just type in 804 right here and recalculate. You know what I'm saying? Oh, it ain't supposed to look like that. Hold up. Let me go back. I put it at the wrong one. Wrong side. Let's start again. Tesla option, March 12th, all the way down, 815, 53.53. Auto. Now we want to change this side to 804. 804 is your stop loss. Calculate, boom. So it looks a little bit different now. You know what I'm saying? Yeah, you still got all this red up here, but that's time decay. You're going to get that when your time decay is looking like this. You don't want your time decay to look like that. You want your time decay to look like 0.0 something at least.
Okay.
If you want to get rid of all this red. And then if you want to cancel out all the red that you saw at the bottom, just fluctuate this price up here. Whatever your stop loss is, type it here. Whatever your take profit is, type it here. So that way you have a better range on your chart so you can see this is where I'm at. You know, and then you can go back to TradingView and set your alerts at each spot. So if one of them get hit, then you know to get in or get out or whatever the case may be.
Okay.
Right.
One more question too for the call options.
Mm-hmm.
They give you a break-even price, right? A price that you can break even.
Yeah.
Okay.
Yeah. So that's right here. You see that break even.
Gotcha. Okay.
Yeah.
Anything over that is profit. Anything under that, I'm taking a negative.
To be honest with you, if you're in the money, then you're going to start seeing a little bit of profit before you hit this break-even price. But once you actually hit it, then you really doing good.
Okay. That wouldn't be time to sell. You can still play with it and see if it can go over that.
Yeah, that depends on your price target. You know, whatever you have your price target set at, that's what you want to be looking at, you know? So,
okay.
Yeah, if you hit this price and it starts going, and it looks like it's continuing to go up, and you look at this chart and you seeing these green candles like this, then you might want to stay in. You might want to stay in until you see a red candle show up.
Okay. I took a call on that DBX with you last week.
Oh, Dropbox. Yeah. So
yes, I don't think it's looking too good right now though.
Nah, actually, it's starting to turn around. So what I did was I came in right here. I came in at 2380, 2390, I think. Okay, yeah. So you did better than me. I came in right here and then it went down on me. Feel me? But my expiration date is farther out, so I wasn't worried about it. And it looked like it was coming up, then it came back down. Then it gave me a big red candle here. It gave me a big green candle here on the daily, and then the volume is high too. So what happens when you see the volume with the big green candle, then this momentum is going to continue. It's going to continue. So once I seen this, I was like, okay, I'm good. I ain't got to worry about it. And then when market closed on Friday, I closed like basically almost at my strike price. So it left me here looking crazy.
Mhm.
It came back down and now it worked its way all up. So by the time the earnings call comes, February 18th, I should be sitting in the right spot.
So how far is your expiration date, if you mind me asking?
My expiration date on DBX, let me pull it up real quick.
You tend to set it for like a month or 3 weeks or something like that?
Nah, I usually go for like a week after earnings.
I did it 3 weeks.
All right, so my expiration date is on the 26th.
Okay.
Yeah, so I got my expiration. I usually have it marked. So that's another thing I want y'all to see too, right? So when you got your options, contracts and stuff, you want to make sure that you mark your strike price. All right. And then you want to mark your expiration date. I use a line here. Okay. If you want to look for this stuff, you can go on the side and you can see, boom, trend line, vertical line. I usually add a vertical line right here on my expiration date, and I'll even mark it. You click on it, and then you can type on it, hit the gear, boom, EXP, expiration, boom. So that's my expiration date. Here's my strike price. My strike price is $24.50. All right. So price is actually above my strike right now. Doesn't mean I'm in profit, but it makes me feel good as of right now. So this is my expiration date. So earnings call is here. So I still got, it's gonna hold value now, because if the price goes up, I might sell it, but the person that I'm selling to is gonna have a valuable contract because the expiration date still got a week on it. So they might be able to sell it too. They might be able to take my contract and then sell it again after they bought it from me, and still have some good some time decay left on this thing. So that's why it's important for you to get expiration dates that are farther out, because you want to give the person that you're buying, or person that you're selling it to, the opportunity to get some profit as well. And it just makes your contract that much more valuable. It makes you look like a very experienced trader.
Gotcha.
Yeah. Anybody else? All right, cool. So let's go ahead and get into this. All right. So you know how we do. So I'm gonna go ahead and pull up the PowerPoint. Obviously, it's gonna be some reading in here just to explain these things. So what I'm gonna do is, so you see the chart, all right? This is technical analysis. We've been going over fundamental analysis the whole time. Fundamental analysis is basically your news articles, what the analysts are saying, everything that you can read, everything that you can see as far as Robinhood is concerned and all that. But when we start dealing with these charts, that's straight up technical analysis. Now, most people who are traders, they only look at the market one way. If they're on technical analysis, then that's all they rocking with. They don't even care about the news. They just looking at the chart and they're reading the chart and they're going off of what the chart says, and that's it. When you're dealing with fundamental traders, they pull up CNBC, CSNBC. They listen to my man on I forgot his name, but the dude with the bald head who be acting crazy, telling you about different stocks. They listen to him. You know what I mean? Kramer, there you go. Listening to Kramer, they're listening to all the analysts on TV, and that's what they're rocking with. They look at the ticker at the bottom, and that's all they need to place their trades. They call their broker up, or they go on there and do it on their own. That's what they do, and that's it. What I want y'all to do is I want y'all to take the fundamental analysis, and I want you to take the technical analysis, and I want you to pull them both together, okay? When you combine both of them together, that just takes you to a whole nother level of being a more profitable trader and making sure you limit your losses as much as possible. You feel what I'm saying? So most people go one way or the other. You can do that too. You know what I mean? If technical analysis is too much for you to deal with, that's fine. There's no problem. There's nothing wrong with it, but you need to have this information, because why not? It could just make you better, And another thing is, you're never really sure about your entries if you're not able to look at the charts. If all you're going to go off of is the ticker on the bottom of the screen and the news articles and what they're telling you, the timing of the news is always late. All right. There's people who are in the market The insiders, the people who actually have the information firsthand, they make the moves already. They're already in position. By the time the news comes out, it's too late. So even though you're reacting with the public, you're still going to be able to profit. But why wouldn't you want to be a step before the public? You can be a step before the public if you understand technical analysis. So normally what happens to me when I'm on my A game, I'm looking at a trade like Dropbox, and I wasn't tapped in like I should have been. If I was tapped in like I should have been, I might have came in right here, or I might have came in right here. Now, let's just use this as an example. If I would have came in right here, it would have been because I'm looking to go in and I'm looking to buy. I'm looking at the candles and it's looking like it's trying to come up, even though it's on a downtrend. Once I seen this green candle up here, almost cross both of these, then I'm waiting for it to hit its floor, right? So when I say, oh, it hit its floor, I know y'all see me text that in the chat, it hit its floor, it's hit its floor. Basically what I'm saying is it hit its lowest point. So it hit a low point down here, and then it tried to come back again, and it couldn't get as low as it did last time. And then it tried to come back again. So that means it's a higher low, right? So this is a low, this is a low, this is a low, this low, and this low. This low was higher than this low. This low was higher than this low. So this higher lows, higher lows, higher lows, higher highs, right? So you see, I saw 3 higher lows in a row. Then I know that the floor was down here and I'm looking for a buy entry. If I bought right here, then I bought right here, and that's it. Coincidentally, a news article comes out the same day. Hey, Dropbox just acquired such and such and such and such. You beat the news because the insiders already had the information that the news was going to come out with today. You hear what I'm saying? So the insiders knew what was going to happen back then. That's the reason why this green candle popped up out of nowhere. This big green candle popped up because all the insiders knew that the acquisition was going to come up. They already came in here. Now you saw that, you looking at the chart as a technical trader and you looking at this like, damn, what's up with this green candle? All right, let's stay in tune. Boom, higher low, higher low. All right, boom, I'm buying in now. Then all of a sudden the news comes out and you beat the news. Now that the news comes out, the general public starts buying in, but you already in position. Only technical analysis can allow you to do that because you're not an insider. You don't know what's going on with the news in the company unless you know somebody that knows somebody that knows somebody. 9 times out of 10, you out of the loop. So, but if you in the technical analysis, then you can always beat the news just by looking at the charts, because the charts is going to tell you what's going on with the market and the pricing and whatnot. This big green candle didn't happen just because. This big green candle happened because somebody, 3 or 4 different hedge fund companies all got the information quick. They bought in. You know what I mean? Some people sold off, whatever the case may be, but this green candle didn't just pop up out of nowhere. So you saw this, you know what to do with the rest of this information. You bought in. Then the news came out. Then the price got driven up. You feel me? So only technical analysis allow you to do that. That was just a quick example before we get into it. All right. So let's go ahead and get into this. All right. Let's talk about candlesticks first. All right, cool. Let's talk about these candles. All right, understanding basic candlestick charts. Candlestick charts, basically what you just saw, okay? So candlestick charts originated in Japan over 100 years before the West developed the bar and point and figure charts. In the 1700s, a Japanese man named Homa discovered that while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. Candlesticks show that emotion by visually representing the size of price moves with different colors. Traders use the candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of price. All right. Candlestick charts are used by traders to determine possible price movement based on past patterns. Candlesticks are useful when trading as they show 4 price points: open, close, high, and low throughout the period of time the trader specifies. Many algorithms are based on the same price information shown in candlestick charts. Trading is often dictated by emotion, which can be read in candlestick charts. All right. If you look into your members area, I gave you a few things that I'm gonna pull up for you in a second. You have a cheat sheet, a candlestick cheat sheet, and you have a pattern, candlestick pattern cheat sheet. All right. Both of those are going to help you look at the market in a different way and help you know where the price movement is going to go based on the probability of the candlestick and the probability of the pattern that you see. Also, I recommended a book for you to check out. All right, Candlestick Trading Bible. Definitely check out that book. All right, so you combine all that stuff together and you'll be able to basically read the chart like a book. Just like the bar chart, a daily candlestick shows the market's open, high, low, and close price for the day. The candlestick has a wide part, which is called the real body. So this part right here is the body. This big part, that's the body of the candle, all right? The high price at the top, the open price at the top of the actual body, close price at the bottom of the body, low price at the bottom of the wick, all right? So on a green candle or a bullish candle, the open price, it opens here and then it closes here. All right. And then vice versa for the bearish candle. All right. The real body represents the price range between the open close of that day's trading. When the real body is filled in or black, it means the close was lower than the open. If the real body is empty, it means the close was higher than the open. So that all depends on how you look at your chart. You can always fluctuate the look of your chart. I'll show you how to do that. Traders can alter these colors in their trading platform. For example, a down candle is often shaded red instead of black, and up candles are often shaded green instead of white. All right, so candlestick versus bar charts. All right, we pretty much know the difference between that. I started out showing you the line charts. Bar charts, we don't even really have to address that. We're just going to stick with candlesticks for now. Basic candlestick patterns. Candlesticks are created by up and down movements in the price. While these price movements sometimes appear random, at other times they form patterns that traders use for analysis and trading purposes. There are many candlestick patterns. Here's a sampling to get you started. Patterns are separated into bullish and bearish. Bullish patterns indicate that the price is likely to rise, while bearish patterns indicate that the price is likely to fall. No pattern works all the time, as candlestick patterns represent tendencies in price movements, not guarantees. So I gave you a cheat sheet for that, and we'll get into that in a second. All right, so these are a few that you can check out in the cheat sheet that I sent you. Well, we'll go over them now so you're familiar. Bearish engulfing pattern, okay? A bearish engulfing pattern develops in an uptrend when the seller outnumbers the buyers. This action is reflected by a long real red body engulfing a small green real body. The pattern indicates that sellers are back in control and the price could continue to decline. So when you see 3 upward candles, 3 bullish candles, and then all of a sudden you see 1 red candle that completely engulfs the previous candle. Sometimes it'll engulf the previous 3 candles, depending on how big it is. But if this candle is bigger than the previous candle, then that lets you know that the sellers are stronger than the buyers for this particular time frame, and it might be a change in trend. All right. Bullish engulfing pattern, same thing in reverse. All right. An engulfing pattern on the bullish side of the market takes place when buyers outpace sellers. This is reflected in the chart by a long green real body engulfing a small red real body. With bulls having established some control, the price could head higher. All right. I'm gonna show you all these examples on the chart. Bearish evening star. All right. An evening star is a topping pattern. It is identified by the last candle in the pattern opening below the previous day's small real body. The small real body can be either red or green. The last candle closes deep into the real body of the candles 2 days prior. The pattern shows a stalling of the buyers and then the seller's taking control. More selling could develop. So evening star, all right? We're gonna pull all that stuff up for you. Bearish Harami. A bearish Harami is a small real body completely inside the previous day's real body. This is not so much of a pattern to act on, but it could be one to watch. The pattern shows an indecision in the part of the buyers. Excuse me. Pattern shows an indecision on part of the buyers. If the price continues to higher afterwards, all may still be well with the uptrend, but a down candle following this pattern indicates further slide. Bullish Harami, basically the same thing in reverse. A bullish Harami is the opposite of the upside down bearish Harami. A downtrend is in play. A small real body occurs inside the large real body of the previous day. This tells the technician that the trend is pausing. If it is followed by another up day, more upside could be forthcoming. So all this stuff is based on the daily chart. And that's usually what we're looking at for our options contracts. Bearish Harami cross, all right, a bearish Harami cross occurs in an uptrend where an up candle is followed by a doji. The session where the candle has a virtually equal open and close. The doji is within the real body of the prior session. The implications are the same as the bearish Harami. So this right here is a doji where there's really no body at all. It's just, it looks like the sellers and the buyers are basically conflicted, but the doji is taking place within the previous candle's body. So it's like neck and neck with the last candle, but there's no body here. That's basically a bearish Harami cross. Same thing with the bullish Harami cross. It's looking like the tide is changing and it might continue to go up, all right? Or it might change in price and go up. All right, bearish rising 3. Should be a picture for this, right? Bearish rising 3, this pattern starts out what is called a long white day. Then on the second, third, and fourth day, fourth trading sessions, small real bodies move the price lower, but they'll still stay within the price range of the long white day. The fifth and last day of the pattern is another long white day. Even though the pattern shows us that the price is falling for 3 straight days, a new low is not seen, and the bull traders prepare for the next move up. A slight variation of this pattern is when the second day gaps up slightly following the first long up day. Everything else about the pattern is the same. It looks a little different when that variation occurs. It's called a bullish mat hold. All right, so there you go right here. So 3 bearish days, all right, and then boom. Basically an engulfing bullish candle right there. Lets you know that the trend is still up, all right? So when we're talking about higher lows and higher highs and stuff like that, when you see this happening, it's almost just like a pullback, and it'll give you a signal to enter long if you see this, basically. Bearish falling 3, same thing in reverse. I want to get to a strategy. So we're gonna leave it at this, and then we're gonna go back to the charts. Then I want to actually pull up some of the stuff in the back end. All right, so if you look at the members area, and I'll pull this up so y'all can see. If you look at the members area in the back end, I want y'all to check out, if you haven't, pull up my account. All right, so if you look at the members area, right? Everybody see this, right? Go down to course materials, all right? And we're on class 3. So open up class 3 and you can see the charts that I got for you. So you got a candlestick patterns cheat sheet right here, and then you got a chart patterns cheat sheet right here, all right? So I'll pull mine up so y'all can see them. We're gonna start with the candlestick cheat sheet. So we just went over all this stuff, right? This is what it looked like. So I want y'all to print this stuff out. You can get it laminated if you can, put it up in your office or whatever, so you have it, all right? So you don't have to always go and look at the definitions and stuff. This is a cheat sheet right here, okay? So this is the doji that we talked about. Spinning top, we'll get into that. This is the bullish candlestick, all right? So if you have your chart and it looks like mine, you see that my bullish candles are green and my bearish candles are red, all right? If you want to change the look of your chart, you simply go to the gear right here up at the top, click on that, and you can change it. The body, obviously we know what the body is now. So you can change the body colors if you want. Some people like black and white. The borders, you can change those. The wick color, you can change that. All this stuff right here, you can change on your chart, okay? If you go up here to the top, you can also change to hollow candles if you want. So if you want it to be hollow candles, you can change them like that too, all right? And then you can go back in here and change them if you want to do that. If you want to change the body, you can change it to hollow by using the occupancy and all that type of stuff. All right, so back to the cheat sheet, right? So the cheat sheet will basically give you all the signals if you're just looking at it. You feel what I'm saying? This is here for you, all right? So the piercing line, Morningstar, Doji, 3 white soldiers, we just went over that. These are all the bullish candlestick patterns. So if you're looking at your chart and you see and you recognize these candles, those can be signals for you to enter a trade. You know what I mean? For the long. Or it could be a signal for you to exit a trade. You know what I mean? If you're willing to, if you're trying to be bullish, if you're bearish on that particular trade. Same thing in reverse, bearish candles. If you want to get short, if you want to short a stock or you want to get a put, then you want to look at this stuff and see where a good entry is for you. So if you recognize any of this stuff on your chart, then you know that it's time for you to go short on a particular stock, all right? When we start talking about these patterns, and you pull up these patterns, I got a chart, I got a cheat sheet for your patterns as well, all right? So you could look at this and you can see these patterns now. I think we was talking about Walmart the other day. Well, I spotted a pattern on Walmart, and people ask me, why you get in right there? Why you get in right there? It's because I saw a pattern. Now I could be wrong, you know what I'm saying? But it looked like a good pattern here to me. If you understand the trend lines and you understand how to market trend lines, now there's people that are going to disagree with me on how I do my trend lines and stuff, but you know, I had a line chart out. The line chart might give you a different trend line than the actual candlestick chart. But as you see, if I'm looking at the line chart, my trend line is accurate, okay? But if I pull up the candlestick chart, it might be a little off depending on your preference. Most people will tell you, if you're dealing with trend lines, they're gonna tell you to connect 2 points for it to be an accurate trend line. So 2 high points. So if I was being accurate, then 2 high points would have been here on the 30th of November. And the second connecting point would be on the 12th of January. And that would be an accurate trend line for the candlesticks, all right? Same thing on the bottom. I want to do October 30th here, and then my second point, it would have been here, depending on when I was looking at the chart. You know, everything is hindsight, but I'm looking at the chart now, so I will put it here, and that would give me a range. And that right there is like that's a pattern right there. So if I pull up my chart, if I pull up my cheat sheet, and I can look and see what pattern I'm looking at, I can look and see what pattern do I see? You know, what pattern do I see? The trend was up. All right, so obviously I'm in the bullish area. It could be a symmetrical triangle. You know, it could be an ascending triangle. It could be a pennant pointing down. If you wanted to come in and put your trend line here, because it's still accurate, all right? Here's a low point here and another low point here. So you could say that that's more accurate than where I had it. That's still valid. That could be a pennant or a flag. Either way, it's bullish. So it came from the bottom, it's consolidating in a different direction, and then it should break out to the top. I saw this on Walmart, All right. So when I'm looking at the chart and I'm looking for an entry, that's the pattern right there. So that's why I was so confident. And they asked me, are you getting out of Walmart? Are you getting out? No, I'm not getting out of Walmart because I see a pattern here. I saw a pattern, all right? It don't matter how I look at it. If I want to put it on the triangle is here. If I wanted to do a flag, the flag is here. If I want to do a pennant, the pennant is here. It's coming up trend and then it's consolidating this way. It's probably going to break out to the top side. So I just wanted to make sure I got a good strike price. Maybe a best strike price would have been down here. But I came in a couple of days early and had to deal with a little bit of drawdown. But you can see that it's on its way back up. If my prediction is correct, earnings call is on the 18th. And as you can see, the previous 3 months have been on an uptrend. All the good news on Walmart is saying that it might beat earnings. So it possibly might break out of this pattern before earnings to the upside, based on my technical analysis and based on my fundamental analysis. When I look up the Walmart stock and I look at the news and everybody's telling me that it's going to be good. Earnings beat earnings last time. And then the estimate is higher, way higher than it was on the previous. So this is the fundamental side. And then when I take it over to the technical side, I use the technical analysis to make sure that I'm in the right direction when I come to my entry and my prediction on the direction of where the market is going, okay? So that's how you combine technical analysis with fundamental analysis to limit your losses, all right? And make accurate trades. Again, you don't have to do all this, but if we're talking about your money and we're talking about making sure that you're on the right side of the market and you're talking about having more wins than losses, it would behoove you to use all of this to your advantage because it's here for you now. Now, I know that a lot of y'all might not be so quick to study the candlestick stuff, but that's why I provided a cheat sheet for you. For me, when I'm dealing with stocks, to be honest, I don't pay as much attention to the actual candlesticks as I probably should. I pay more attention to the patterns than I pay attention to the candlesticks because I'm looking at the structure of the market more so than the actual individual candles. I'm looking at a situation here right now where I have my trend line and then I see this doji right here, then I know that there's not about to be a breakout. I know that it's probably going to go back down because this is doji right here. It's not giving me a decision on what it wants to do. Doji, then the next candle is a bearish candle, then I know it's going to stay within this range. It's going to come down. You feel what I'm saying? And then on here, you see that I wanted it to break out on this side. I thought it was going to break out. I was hoping that the next candle was going to open and just bust out of here. But I got a bearish engulfing candle. This candle basically engulfed the last 3 bullish candles and let me know that we're going to be heading down for a while. Then it hit the trend line, started fluctuating its way back up. Now you got an engulfing bearish candle, but then you got almost a, what is this, an evening star? Let's pull it up real quick. Cheat sheet. Evening star here. Evening star, let me know that it might continue to go down, but it didn't. It gave me a green candle here. So all of this stuff is probability. Obviously, it's not going to be 100% accurate, but it will give you a range. That's why I like going with the patterns more than actual candles, because I want to see the whole structure. Now I'm looking at the whole structure and I see, oh, damn, this looks like a pennant. Or, oh, damn, it look like a symmetrical triangle, or it look like an ascending triangle. I think it's going to break out of this joint bullish. Let me measure it up, see if I can get a good entry, and just wait for it to happen. If I would have came in right here, I probably would have been out of this trade already, but I didn't. I'm up here, so I'm waiting for a breakout. I wanted to break out of this. I want it to do exactly what these patterns are showing me it should do. Now my stop loss, it even gives you the stop loss. My stop loss on this one, if I was going off of the cheat sheet, my stop loss should be somewhere around here, $140. So if price comes all the way down to $140, then I might want to get out of this trade, depending on how I'm feeling. But if I'm waiting for a breakout, then, you know, I'm waiting for a breakout. Now my stop loss is at 143. You see, I got my alarm here, and I also got an alarm here to let me know that a breakout is taking place. All right. So that's how you combine technical analysis and fundamental analysis. All right. Now, for the people who had questions about me trying to figure out how do I get my price points, how do I gauge what my take profit should be, all that stuff, I told you, you could always go with the analysts. You know what I mean? The analysts are going to tell you what they think. So the first year price target right here on Yahoo, it tells you $162.67 for the year. All right. If I go to Markets Insider and look up Walmart, it's going to tell me what some other analysts are saying as far as what they think. Analyst opinions for Walmart, anywhere between 165, 180, 150. You know what I mean? Depending on how I feel about these analysts, I might go off of what they say. But when I'm dealing with technical analysis, and I start dealing with these pivot points, I could pull up the weekly pivots, I could pull up the monthly pivots, and I broke that down last week. All right. If I look at the monthly pivots, it'll tell me for this month, the resistance level is probably going to be around $145.71. All right. On the uptrend. If I wanted to look at the pivots for, everybody should know how to do this. So you pull up your indicators and you just type in pivot. Okay. And I'm about to break that down, what that is right now. If I wanted to look at the yearly, all I gotta do is adjust the time frame, yearly. Boom. All right. Now you see the resistance on this one. If I pull back to the weekly, it's way out. It's way out. It's way out. Wait, maybe I need to change the colors. All right, let me hold on 1 second. Style, yeah, so my colors is black, so you can't see it. So red, all right, boom. And I'll go with the second. Okay, boom. All right, so you see the yearly resistance level is at 170.18. You know what I mean? And you can see how accurate the pivots are if you just look at the previous. You see the previous, it always hits the target. It hits the target every time. You can take the pivot and pull it all the way back to as long as you want, 5, 6, 7 years if you want. So the previous years, usually it hits at least the resistance level or comes close to it. You know what I mean? Back in 2018, it didn't hit resistance, it hit support, okay? But one of these lines is gonna get hit within a year. So last year, it hit the first resistance point and extended all the way up to the second resistance. Then it came down, or 2 years ago. And then last year, boom, it went all the way back up to resistance level 2 last year. Now it's all the way down. Now they're saying that the resistance level is around 170. So that could be a potential price point. But if we go back to what the analysts are saying, they're saying 160, that ain't too far off. That's not too far off, 162. 162 is not too far off. 162 is right around here. So I'm not saying that Walmart is going to break out and bust all the way up to 162, but throughout the rest of the year, it could possibly get up to this point and go beyond. All right. But that's if you're going for the yearly. So if you want to get a year's extension, expiration date on your contract, then that could be a potential price point for you. All right. For me, because we're dealing with weekly contracts and mine expires on the 26th or something like that, I want to go and I want to probably look at the month, and my monthly target has already been hit. The resistance already been hit. All right. So if I look at the weekly, scale down to a 4 hour. If I want to look at the weekly, The weekly is all the way up at 147. As you can see, I already got my alert set around this range. I also have my alert set right before the pivot, okay? So I got my alert set within this range right here. And next week on Tuesday is gonna give me a whole new set of pivots, and I'm gonna see where I'm at. Now, if the pivot point is higher than the previous pivot point, then it lets me know that I'm moving in the right direction. And then my resistance level should probably be up here somewhere, okay? So I use this to help me with my target, my price targets as well. So my technical analysis, price targets will depend on my pivots. And I'm gonna break that down now, all right? So what is a pivot? What is a pivot? A pivot point is a technical analysis indicator or calculations used to determine the overall trend of the market over different time frames. The pivot point itself is simply the average of the intraday high and low and the closing price from the previous trading day. On a subsequent day, trading above the pivot point is thought to indicate ongoing bullish sentiment, while trading below the pivot point indicates bearish sentiment, all right? A pivot point is an intraday technical. All right, we went over that. Pivot point is the basis for the indicator, but it also includes other support and resistance levels that are projected based on pivot point calculations. All these levels help traders see where the price could experience support or resistance. Similarly, if the price moves through these levels, it lets the trader know the price is trending in that direction. So I use the pivot points to help me decide what direction the market is going in. So if we go back to the chart and I look at the weekly pivot, basically, I'm gonna see if I could take some of this stuff off. Let's hide the drawings. All right, so basically what I'm looking at is on what side did the pivot open at for the week. So if I look at 3 weeks ago, price opened above the pivot and then it hit its resistance point. And then it came all the way down to support, broke through the first level, broke through the second level. Then on the second week, it opened below the pivot and then it rose up through the pivot, hit the resistance point, busted through resistance, opened up above the pivot on last week, didn't hit resistance, and now it's going back down. So depending on how you want to look at this, some people will look at this and say, okay, if price opens up above the pivot, then we're in an uptrend for the week. If price opens below the pivot, then we're on the downtrend for the week. But as you can see, price goes directly through each one, right? Usually when that happens, when you see price go straight through the pivot and all the way through a support level, that, to me, that indicates a change in trend, right? It indicates there's a change in trend. And if everything is smooth and it's on an uptrend, then usually price will open above the pivot and just continue to go up. And then the next pivot will open up higher than the previous pivot and it'll just continue to go up, 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 up. And then if it's going down, then it'll open below the pivot, hit the support. Then the next one will open up below, hit the support, below, hit the support. If it starts fluctuating and going past the pivot and then hitting the resistance, hitting support, hitting resistance, hitting support, past the pivot, then it probably is, the price is trying to decide which side it's going to be on. You feel what I'm saying? Once it gains some stability, then it'll show you a more accurate look. So if we go back to where price was just on a steady uptrend, then you may see a little bit more of a steady look. All right. I know this is a lot of lines, but all this stuff is going to help you when it comes to direction. I can minimize and we just go off of the first two. So, you see price hit support, busted through the pivot with this big green candle right here. And then now it's up. And then that, boom, the next pivot, it opened up higher. Boom, now it's higher. Then the next pivot opened up higher. Then it went higher. Once it reaches the second resistance level, it's almost like it's in overbought territory. So if it goes through the first level, then I would probably take profit at the first level and then see what happens after that. If it goes beyond the first level, it's almost like you're being greedy if you're going to use the pivots as a gauge on to whether you're going to have your price targets. All right. So what I do is I use the support level 1 and resistance level 1 as my price targets. So let's say I was long on this particular week right here, right? Let's say I was long this week right here we're looking at, all right? I'll box this up so y'all can see that I'm focusing on this right here. All right, let's say I was long on this. It's Monday, it opened up, all right? And this, I'm looking at the monthly. It opened up first of the month, higher than the pivot, right? This one candle gave me my target. My target is gonna be at the resistance level. Maybe my stop loss is gonna be at the support level 1. So if price goes against me and it reaches down at support level 1, which is $134, at that point, I'll get out of the trade. If price goes up to the resistance level 1, $147, I might cash out right there. That's to me, that's like, okay, I'm being, you know, I'm not being greedy if I stay at that, within that range. Some people like going beyond that and hitting the resistance too. But as you can see, a lot of times it doesn't go beyond that point. So I like keeping it simple. Resistance level 1, support level 1. Same thing if it's in the downtrend. If I want to go bullish, on this, move to this area right here. I'm sorry, if I want to go bearish and saw that on the first of the month, price opened below the pivot. So for this month, I might be bearish on Walmart. I might put my stop loss at resistance level 1 and put my take profit at support level 1. All right, as you can see, price opened up June 1st under the pivot level and started working its way down. I got a put option, you know what I mean? My strike price might have been at 124. My take profit might be at 117. It's working its way down. Boom, it hit 117, I'm out. It hit support, then it started working against me. I'm out, I got out. You feel me? So you can use the pivot points as a good range on whether you want to judge what your take profit is, your stop loss is, along with the analyst. So if the analyst is telling you this and you got that working in your favor according to the pivots, then that's just another layer of confluence for you for that particular month or week or whatever time frame you want to go on. All right. Just keep in mind when you're dealing with these time frames, you want to make sure that your contract it makes sense. So let's say, for instance, your expiration date is a whole month out, then you want to look at the monthly pivots. If your expiration date is a week away from now, then you want to look at the weekly pivots. If you want to day trade, I know we got some day traders on here. If you want to day trade, then maybe you want to look at the daily pivots. But if you want to look at the daily pivots, you're gonna have to scroll down to a lower time frame, like a 15-minute time frame. You know what I mean? You want to scroll down to a 15-minute time frame. All right. So that way you could use them in its proper, you know, in its proper time frame. All right. But normally when you're dealing with options contracts, you want to look at higher time frames because we're gonna hold them for a little longer than a day. You don't want to get hit with that pattern day trading stuff. All right. So back to the PowerPoint. All right, so all right, so there's a formula for the pivot points in case you're wondering. All right, so obviously we just went over that. P is the pivot point. You got resistance 1, resistance 2, support level 1, support level 2. Here is the formula, okay? It's not one of those things where you got to sit down and calculate. We have the ability to use the TradingView platform. And the indicators on there, it does everything for you. So you don't need to plug in these formulas, but if you want to, you can. So the high indicates the high price from the prior trading day. Low indicates the price from the prior trade, the low price from the previous trading day, and close indicates the closing price from the previous. So they take the highest point of the previous day, the lowest point of the previous day, and the close of the previous day. They calculate them all together, and boom, they have the next day or the next week or the next month's pivot points, support level, and resistance. All right. This stuff is pretty accurate. As you can see on the chart, you know, that stuff is pretty accurate. It usually stays within that range. All right. The pivot point indicator can be added to a chart, which what we just saw, automatically will be calculated and shown. All right. What do the pivot points tell you? Pivot points are an intraday indicator for trading futures, commodities, and stocks. Unlike moving averages or oscillators, they are static and remain at the same price throughout the day. This means traders can use these levels to help plan out their trading in advance. For example, they know that if price falls below the pivot point, they will likely be shorting early in the session. If the price is above the pivot point, they will be buying. So S1, S2, R1, and R2 can be used as target prices for such trades, as well as stop loss levels. I just went through that. All right. Combining pivot points with other trend indicators is common practice with traders. A pivot point that also overlaps or converges with a 50 period or a 200 period moving average or Fibonacci extension level becomes a stronger support and resistance level. I'm about to get into that. All right. The difference between pivot points and Fibonacci retracements. Pivot points and Fibonacci retracements are extensions. Both draw horizontal lines to mark potential support and resistance areas. The Fibonacci indicator is useful because it can be drawn between any two significant price points, such as a high and a low. It will then create the levels between those 2 points. Fibonacci retracements and extension levels can be thus created by connecting any price point on the chart. Once the levels are chosen, then lines are drawn at percentages of the price range selected. Pivot points, in contrast, do not use percentages and are based on a set fixed number, high, low, and close of the prior day. So I have to ask y'all about this, and then we'll move forward after that. Pivot points are based on simple calculation. All right. My bad. Pivot points are based on simple calculation, and while they work for some traders, others might not find them useful. There is no assurance the price will stop at, reverse at, or even reach these levels created on the chart. Other times, the price will make a move back and forth throughout a level. As with all indicators, it should only be used as part of a trading plan. So obviously, it's not a 100% guarantee that the price will stay within those range or hit these points or hit these points. We just use this as a level of confluence, all right? So I have to ask y'all, because I don't want to overdo this meeting, but do y'all want to get into Fibonacci? Because I have a PowerPoint ready. If y'all want to get into Fibonacci, we can get into Fibonacci.
Yes.
You want to get into that?
Yep.
Get into that? Let's do it. All right, cool. I just didn't want to take drag this out longer than it had to be, but let's go ahead and get it popping, man.
Mill, my quick question is, are we going to be able to follow you?
As far as what?
On my trading view. I'm doing it with you.
I mean, to be honest with you, I didn't set mine up like that, but let me look into it. If I can figure out how that stuff works, y'all can do it. I don't really know, because I didn't set any of that stuff up when I got on here, but I will definitely do that for y'all, because that might make it easier for everybody. If y'all can follow me, then I can just put my stuff on here, and then y'all should be able to do it. Because on TradingView, you can actually hit the play button. Like obviously I could, send my images to you, but I can actually, let me see, my ideas. I could put my trading ideas in here. So yeah, let me play with that. And then I'll let y'all know. All right. I'm gonna set that up for y'all. All right. So y'all want to get in Fibonacci. All right. So let's just show you where it's at first, right? So on the left side, you got your tools here, right? You want to find your Fibonacci. It should be 1, 2, 3. It should be the third level here. You click it, and then you scroll down and you look. All right, so you got Fibonacci retracement here, and then you got trend-based fib extension here. Then you got fib time zone, fib circles, all this other stuff. We're just gonna go over fib retracement right now. So make sure you click fib retracement. If you click the star, then it will open up this little toolbar here, right? So you could put all this, your favorite stuff on the toolbar. I got fib right here on the toolbar. You feel what I'm saying? So I'm gonna break down exactly what Fibonacci is, and then I'm gonna give you an example on how to use it. All right. So let's get into it. Y'all wanna get into it? We're gonna get into it. All right. What are Fibonacci retracements? What are Fibonacci ratios? So the fibs, right? Fibonacci retracements are popular among technical traders. They are based on the key numbers identified by mathematician Leonardo Fibonacci in the 13th century. Fibonacci's sequence of numbers is not as important as the mathematical relationships expressed as ratios between the numbers in the series. In technical analysis, a Fibonacci retracement is created by taking two extreme points, usually a peak and I'm gonna say a bottom, so the high and the low, on a stock chart, and dividing the vertical distance between the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%. All this stuff is already calculated on the actual indicator. I'm gonna show you. Once these levels are identified, horizontal lines are drawn and used to identify possible support and resistance levels. All right. Fibonacci retracements are popular tools that traders use and can use to draw support lines, identify resistance levels, place stop loss orders, and set target prices. A Fibonacci retracement is created by taking two extreme points on the stock chart and dividing the vertical distance by the key Fibonacci ratios. Fibonacci retracements suffer from the same drawbacks and other universal trading tools, so they are best used in conjunction with other indicators. So a lot of people that use Fibonacci live and die by Fibonacci. All right. I'm sure a lot of y'all who are into trading know this. When people start talking about Fibonacci, if they're a Fibonacci trader, they live and die by it. All right. What you're supposed to do is you're supposed to use it as another layer of confluence along with other indicators to let you know support, resistance, and then sometimes you can use it as an entry. Sometimes you can mark your stop loss. I'm gonna show you how to do that and use it as take profit, find your take profit levels and all that. But usually the people that are into Fibonacci, they live and die by it, and that's all they want to rock with. So some of y'all might fall in love with it too, but I use it just as another layer of confluence to let me know that I'm on the right side of the market and that my target prices and stop losses and stuff might be accurate. All right. How the ratios work, before we can understand why these ratios were chosen, let's review the Fibonacci number series. All right. The Fibonacci sequence of numbers is as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, etc. Each term in this sequence is simply the sum of the two preceding terms, and the sequence continues infinitely. One of the remarkable characteristics of this numerical sequence is that each number is approximately 1.618 times greater than the preceding number. This common relationship between every number in the series is the foundation of the ratios used by technical traders to determine retracement levels. So if anybody understands like geometry, this is part of, like, some people consider this sacred geometry, I guess you could say, where we're looking at different shapes that are just here throughout the universe, like a flower, like the symmetrical shape within a flower, how everything is perfect. They use that as an example of Fibonacci. So Fibonacci tried to basically take a flower and look at it and apply mathematical ratios according to that shape to determine how a flower can go from the center all the way out to the base of it, and look at how evenly symmetric it is throughout its whole body using mathematics. That's basically how they got to that. So they can explain, they want to use mathematics to explain everything that's naturally here in the universe. And then they took this same strategy and same sequence and applied it to the actual markets. And coincidentally, it actually fits on the chart. So I'm gonna show it to you as well. The key Fibonacci ratio of 61.8 is found by dividing one number in the series by the number that follows it. For example, 21 divided by 34 equals 0.6176, and 55 divided by 89 equals about 0.61798. Same thing with 38.2, 23.6. Basically, you know, we're looking at the ratios and how they work according to these numbers. All right. Fibonacci retracements and predicting stock prices. Okay. So for unknown reasons, these Fibonacci ratios seem to play a role in the stock market, just as they do in nature. Technical traders attempt to use them to determine critical points where an asset price momentum is likely to reverse. Fibonacci retracements are the most widely used of all the Fibonacci trading tools. That is partly because of their relative simplicity and partly due to their applicability to almost any trading instrument. They can be used to draw support lines, identify resistance levels, place stop loss orders, and set target prices. Fibonacci ratios could even act as primary mechanism in a counter trend trading strategy. Okay. Fibonacci retracement levels are horizontal lines that indicate the possible locations of support and resistance levels. Each level is associated with one of the above ratios of percentages. It shows how much of a prior move the price has retraced. The direction of the previous trend is likely to continue. However, the price of the asset usually retraces to one of the ratios listed above before that happens. The following chart illustrates how Fibonacci retracement appears. Most modern trading platforms contain a tool that automatically draws the horizontal lines. Notice how the price changes direction as it approaches the support and resistance levels. In addition to ratios described above, many traders also like using the 50% level. So let's put a pause on that and get to the charts. All right. So let's use we can use the Walmart as an example. All right. So for me, because I use Fibonacci so much, I can pretty much look at a chart and tell you whether it'll fit on there or not. Don't try to force the Fibonacci retracement tool on a chart. Either it fits or it don't. Either it fits or it don't. Don't try to force it, okay? I'm gonna show you how to use it, but you know, there's an argument on whether it should be used in certain scenarios or not, but I'll just show you how to use it. All right, so let's look at this one for example. All right, so we're gonna focus on, I don't know why this thing does this. 1 second. So we're gonna focus on this right here. We're gonna focus on this area right here. We're gonna focus on this area right here, okay? All right, so everybody sees this area. All right, so basically what I'm gonna do is I'm gonna take my Fibonacci retracement tool, right? Now, when you're using the Fibonacci retracement tool, you wanna, for an uptrend, you wanna go from swing low, so the lowest point, to swing high, to the highest point, all right? So the lowest point is down here, the highest point is up here. All right, you know this because if the trend is going up, and it hit this point right here, and it starts to retrace, which means it starts to go down. When I say, oh, waiting for a pullback, it pulled back after this, and it starts to go down, right? So that's the 100% level up top. Once price hit the 100% level, it goes down. Now, all we're looking for is at what point is price going to start going back up? Okay, so we're using the Fibonacci retracement tool. Remember, Fibonacci retracement tool, keyword retracement. So we're looking for a retracement. We're not looking for nothing else. We're looking for where the market is going to pull back and where is it stopping at, okay? So the rules that we normally use when we're dealing with Fibonacci is if price goes beyond the 78.6 level, let me move this so y'all can see. You see that 78.6% right here? If it goes beyond this, and I got mine at red to let me know that once it goes beyond this red point, it's a little iffy. All right, as far as it staying in the uptrend, okay? Now, when I say that you don't just live and die by Fibonacci, you use this in confluence with other indicators. You see I got my 50 moving average and my 200 moving average. Price crossed the 50 and the 200 to the downside. So that let me know that it could potentially change in trend. Also, I'll put the Fibonacci on here, and it actually went all the way down to the 78.6 level, but it stopped. It stopped. So if it went all the way down here, then I would be like, oh no, trend has completely changed. Now we is downward momentum. We're in the bearish market now. I'm looking for sell entries. I'm not looking for buy entries no more because it just went all the way beyond my fib. It crossed over my 200 and my 50. You feel me? And then when we start talking about the RSI and the stochastic, which is next up, all this stuff right here lets me know that we're in we could potentially be going into a seller's market, but price stopped and it started to retrace and go back up. So when we using the Fibonacci, we're using the Fibonacci levels as potential entries, potential stop loss, potential take profit. So I got my fib on here, right? Price went all the way down to 78.6 and then it started going back. Now, if price continues to go up, I'm looking for buy entries. At this point, if I want to go long, I'm not being greedy, I'm going to put my take profit at the 100% level up here. So I'm going to bank on price going back to its previous level and extend beyond that. There's a Fibonacci extension tool on here as well to show you where the extension levels are, but I'm not greedy. I'm going to go for the 100% level, put my price target right here, and then have my stop loss potentially down here. So if I enter the trade, I might enter the trade here. I might enter the trade here at 61.8. I might enter at the 50% level, 38% level, 23% level. I gave myself 1, 2, 3, 4, 5 potential entry points with my target price up here at a previous high. You feel what I'm saying? So that's one example. Let's find another one. I don't want to use Walmart. Let's find something different. Let's look at Dropbox. All right. And we can, okay, so let's use Dropbox as an example to look at bearish movement. All right. So bearish movement. Pull my Fibonacci out, right? We're going to go from swing high to swing low now. Swing high to swing low. So you see high point, low point, okay? High point, low point. And I extended it all the way out as far as you need to extend it out, but that's where it's at. So if I pull this up, I'm looking for a retracement now. So you see price stopped and it retraced. It retraced all the way back to the 50% level. And coincidentally, it also respected my 50 moving average. So those two levels of confluence that I have to let me know that we're still in a bearish seller's market. So my entry might be around here. I might put my stop loss at the 61.8, and I might put my take profit at the 100% level up here at a previous low of $17.15. All right. If you're in TradingView, easy thing for you to do, go to the side here, and you can look at long positions, short positions. All right. I'll put up a short position, have my entry here at 50% level, put my stop loss at 618, put my take profit at the 100%. All right. And boom, there you go. So that's how a Fibonacci trader would use a Fibonacci extension to get in and out of a trade and measure their trades according to this tool right here, okay? So that would be a bullish position right there. That right there is probably the smoothest example that I could give you, because I have my 200 moving average and my 50 moving average. My 200 moving average, my 50 moving average crossed over my 200 into the seller's market, okay? I got my swing low and my swing high, price retraced, stopped at the 50% level, and it respected my moving average. I'm gonna enter here, set my stop loss here, give myself some room, which happened to be beyond the 200 level. And then I'm gonna have my price target at the 100% level. And boom, target was hit. Even though it came back and touched the 50, touched the moving average again, I'm still in profit the whole entire time. It hit my price target. I exited the trade. That was an easy, smooth win right there. All right. I'll give you another example. So, perfect example. This was what? This was November 25th. Pull out my Fibonacci extension, swing low, swing high. Swing low to swing high. All right. Price stopped. And let me give you a better example. So in TradingView, you can do the replay, right? You can do the replay. Let's say, for instance, we've been watching this. We've been watching Dropbox. All right. You've seen price go up. So when I say don't come in now, wait for a retracement, wait for a retracement, wait for a retracement. So we're looking for a retracement. We're looking for a retracement. Boom. Price stopped here. And now you gave me this big bearish engulfing candle, right? Bearish engulfing candle here. And now we're looking for where the retracement is going to stop. So we're looking for it. And we see that the bearish engulfing candle came. At this point, I can look at putting on my fib. I can look at putting on my fib. Let's go forward. Okay, boom. Now I'm putting on the fib now. So now I know that price is retracing. Once it starts retracing, I can put the fib on. So I go from swing low to swing high. Now, some people will argue with me and say, oh, you should have had it down here. Some people say, oh, no, this is good. To me, it really don't matter. If you want to do it like that, you can pull it down to the low point. That's fine. All right. So boom, swing low all the way to swing high. Now we waiting on it to stop retracing. That's what we're waiting on. Okay. So we're waiting on it to stop. It's going, it's going, it's going, it's going. Okay, boom. Now you can start reading the candles now. You can see this candle look like it was some buyer's momentum. Then you give me a green candle here. Up, still going down. Up, gave me a bullish engulfing candle. Okay. All right, now this candle opened up higher than the previous one. All right, boom. Now you gave me this one. So if you was looking at it like a Fibonacci trader would look at it, the Fibonacci trader would have looked at this bullish engulfing candle and said, I'm getting in now. I'm getting in for a long entry because now I got my 50 moving average just crossed over my 200. Okay. I retraced all the way down, almost touched the 50% level. Most traders say that a 50% retracement is where you want to be. A lot of traders say that once it gets to 50%, then normally it's going to continue to go up after that point. 50% retracement is a good level for you to start looking at getting into a long entry. Same thing for a short entry. The last example I gave you was around 50%. This example is a 50%. Some people will argue on that, but for me, if I wanted to enter in 50%, once it starts retracing and stops at 50, I would say that's a pretty good long entry. So I will go in here, get my long entry in, put my price target at the 100% level. All right, I might even move my stop loss up to 50% if I'm feeling like that. You know what I mean? Or keep it beyond the 2 moving averages maybe. All right, either way, my ratio is good, okay? So boom, I'm entering the trade and I'm gonna see what happens, all right? Up, 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 and it might go against you. It might go against you, but if you depend on the Fibonacci, then you gotta go with what you believe in, all right? So boom, target was hit, okay? So that's how you would use a Fibonacci to measure your moves, okay? I'll do one more example for you. And that's just something that you gotta play around with. I don't know if this replay mode is available for the free TradingView subscription or not, but it's definitely a tool that you can use to your advantage. And another thing too, some people may argue with me about this. I like using the line chart with Fibonacci too. It doesn't really make a difference to me whether I'm using the line chart or the candles. As you can see, price is price. You know what I'm saying? Price is going to do what price is going to do. So I could put it on here. If it's easier for you to look at, you can use it with the line chart as well. As you can see, almost touched the 50 and went back up. All right. Those are a few examples. Now you see, it's not always going to fit on the chart. You know what I mean? It's not always going to fit. It's not always going to fit. But if you're a Fibonacci person and you can see it, you can look at it. You can look at it however you want to look at it. I could stretch it out here. You can see, boom, low point, high point, retracement all the way down to 618. Didn't go beyond the red. Okay, so it fits perfectly. I might wait until it goes up to 50%, then I might enter here. Boom. Could have made money right there. You know, if you could pull it back, put the fib on here. Same thing. High point, low point, retraced all the way, almost touched the 50. Boom. Would have been a good short entry right there. All right. Same thing here. Low point, high point. All right. Retraced all the way down, 618, didn't touch the 78. I could have entered here at the 50% level. Boom, target hit. Okay. So there's countless examples on these charts. If you want to use the line chart or the candlestick chart, it's up to you. Let's see what else. What else was we looking at? I think I pulled up Momo the other day. Pulled up Momo. Let's see if Fibonacci. Now this is the daily. Obviously, we're on the daily chart, but you don't have to use the daily. It works on the 4 hour. It works on the 1 hour. It works on the 2 hour. It pretty much works on every time frame. I don't really use it when I go down to 5 minute, 15 minute, but I'm not saying that it doesn't work. I'm just saying that I don't really use it when I go down to those small time frames, but it works pretty much on every time frame. I'm on the 1 hour right now. I'll pull it up. I see it probably fits right here. Boom, low point, high point. All right, retraced all the way down. As you can see, I got 2 layers of confluence. Didn't go beyond 6.8. I mean, didn't go beyond 78.6. It actually respected my 50 moving average. I could have entered here at the 50% level, put my price target at 100, put my stop loss here, boom, target hit. All right. Same thing on the next go around. Low point to high point. Boom. Price retraced all the way down. Could have entered here. Boom. Target hit. Okay. Now you can see why some people live and die by Fibonacci. Low point, high point. Retraced all the way down to the 50% level. I could have entered here. Boom. Target hit. All right. Countless examples. Okay. Same thing in the seller's market. In the seller's market. Okay. I think this might have been the COVID drop. High point to low point. All right. You could drag it all the way out. Price retraced all the way back to almost touched the 38.2 level. Then it started going up. You could have entered here. Could have entered here. Could have had your stop loss at 38.2. Could have had your take profit at the 100% level. Boom, target hit. All right. So that's how you use the Fibonacci. Okay. Did I do good with my examples, or do y'all need more?
You did great.
Great.
I like it.
Okay, cool. So does everybody pretty much have a good understanding on how to use Fibonacci?
Thank you, sir. Awesome.
Yep.
All right, so this is a good tool for you to use when you're measuring your moves. Again, Fibonacci retracement, okay? It doesn't fit on everything, but if you're looking at the market and you're watching it, we can use this as an example. All right, we're looking at Momo. You saw Momo had a little spike last week. Okay, I don't know if anybody got in it or not, but you see Momo had a spike. I'm not getting in. I'm waiting to see what the retracement looks like. As you can see, price came down. It might continue to go down. If it continues to go down, what will I do? I'm gonna pull out my Fibonacci, go from low to previous high, and I'm gonna wait to see where it stops at. If it comes all the way down to 50% level and starts looking like it's gonna come back up, I might enter here. I might pull up my, where's my Robinhood? I might pull up my Robinhood and I might pull up my Robinhood, go to Momo, okay? Pull up my Robinhood, go to Momo, and see where we was at. Now, let's say price came all the way down to the 50% level. That's around 1841, all right? Using TradingView, I might put my entry here, put my stop loss here, okay? Put my target here. Now I'm looking for strike prices around, I'm looking for strike prices around 1850 or whatnot. So I'm going pull up, what I said, Momo. I might pull up Momo and start looking at strike prices at $18. Okay, boom, 18.5. Okay, boom, that's a good one. 18.5. I like that. 18.5, expiration February 26, $196 investment. I go to my long calculator, type in Momo. All right, try to find that February 26, 18.5. How much did I say? 196. Okay, boom, 196 here. Got one contract, calculated. Boom. All right. So now let's put it all together now. Okay. So we had the chart. Okay. I got my strike price at 18.5. Okay. I got my strike price at 18.5. All right. I got my stop loss somewhere around 17.9. So let's see where it is. 17.9. That's too low for me. All right, on here. So let's go back and adjust it and see what's reasonable. All right. What's reasonable? 18.25. Let's see if that's reasonable. 18.25. Nope, that ain't reasonable. I'm looking at this chart. I say, okay, I might let it go to 19.4. 19.4. Actually, hold up. Something ain't right. 19.4. Okay, yeah. So obviously we're thinking in the future. So obviously it's not going to be up here. But let's just say, for instance, it was here. I would use the long calculator and I would type my stop loss in right here. All right. I would type my stop loss in right here. I will put 19.4 in, and then I will put my take profit, which would be my 100% level at 2028. And I would type that in right there. It will calculate it, and it will make my options profit calculator chart be confluent with my TradingView chart and my long position right here. So take profit will be here, 100% level, boom, stop loss here, entry here, mark this here, mark it here, mark it here. And then
can you do it so that we can see it on the long calculator? Because that's where it confuses me.
Okay, boom. So all right, so let's rewind it and see. How can I do this? How can I do this? How can I do this? Maybe I can use an example that I already have. Let's okay, so let's use Walmart and see. All right. Since we already in this trade. All right, boom. Put the fib on here. Low, swing high. All right. Price is fluctuating at between the 32.6 level and 38.2. All right. I happen to have a contract for this particular one. I pull up my contract for Walmart. All right, so I got my contract here. Okay. And then I have my stop loss set. And that would be an extension. My stop loss is here, okay? Let me make this a little darker so y'all can see. All right. So everybody see that, right? Do I need to adjust the colors at all? Are y'all good?
No, we're good. I can see it.
All right, cool. So I put the fib on here, right? Swing low to swing high, okay? I seen the retracement, okay? Also, I got my moving averages here, and my 50%, my 50 moving average is being respected by the price. Price is bouncing off the 50, all right? I have my entry here. Now my entry was back here. My entry was back here. So at one point I was in profit, but price rejected and it didn't hit my stop loss yet. So that's where I'm at, okay? Matter of fact, I really came in right here. I think I came in right here, actually. No, okay, yeah, so I came in right here, all right. I came in right here, price went up, then it came back down, okay? If I look at my options profit calculator, my stop loss is $143.56. So boom, 143. Let's see if I can, 143.56. So I would be somewhere between this area right here. My stop loss. So this is how much I'm willing to lose. All right, that's my stop loss on TradingView, my stop loss on the options profit calculator. Y'all, everybody understand that? Everybody understand that?
Yeah, I got you. I
Yeah,
got
got
you.
it.
I got you.
Yeah.
Let me make sure I want to make sure y'all see this. I know y'all said y'all see it. I just want to make sure y'all got it though. But whatever. So yeah, so y'all see that. All right. So this is where this is the price range I'm at right here. All right, for my stop loss. Okay. My take profit is 147.54. Okay. So 147.54, which is like around here. All right. That's not necessarily my take profit. That's what I was willing to take at that particular moment in time. But just for the sake of this, we're gonna say, cool, your take profit is here. Now, what's today? February 14th. This is the date where the earnings call is, but my expiration date is all the way here. You feel me? So I want price to at least hit around this area. So if it hits this area, I'm cool with walking away with $144 in profit. Basically is what I'm saying. If it goes against me, I'm cool with walking away with a $408 loss instead of $810. Y'all got that? Does everybody understand that?
Yeah.
So
Yeah, I understand you.
So you're looking at the date, all right? So the actual earnings call date is February 18th. All right, so you want to mark this stuff. February 18th is my deadline. I don't want to hold this contract beyond this day because that's the earnings call. Yes, my expiration date is on the 26th, but I anticipate getting rid of this contract before this date comes, all right? I know that price is going against me at this particular moment in time, but again, if I want to use the Fibonacci, sequence, and I think that price is on its way back up, it retraced at the 23.6% level. My take profit normally would be at the 100% level, but as you can see, if you look at the chart, $146 ain't really going to give me nothing. It's actually going to have me in the negative because of time decay. You feel what I'm saying? So in this particular scenario, my target was actually the previous high, which was 147. So I know it's going to at least get back to this point. It's probably going to get back to this point. You feel me? But the alarm that I got here is set to let me know that it's on its way for a breakout. If it happens to get close to this point before the earnings call, I might just let go because I might not want to risk it rejecting this trend line and going against me again like it did before in the past. But if I'm right, then my price target should really be up here somewhere. Let's go to the daily. If I go to the daily chart, my price target should really be up here if I really want it to break out. You feel what I'm saying? So the alarm that I got set here is to let me know that the breakout has actually occurred. But my price target really should be up here somewhere if I'm confident in what I'm doing. Again, if price hits this point, I'm probably going to end up selling because I held it. It was in the negative for a long time. I don't want to play with the market like that. So if it hits this point, I'll probably end up selling. But realistically, if I'm really, really confident in the Fibonacci sequence and I'm on a daily time frame, my Fibonacci sequence will probably be here, low to high. Oh, that's the wrong one. Here, low, swing low to swing high, retraced all the way down to 38.2. All right. If I think the retracement is finished, then again, my price target should really be right here, 100% level, which is $153.09. $153.09 will put me at around $856 profit. If I really wanted to believe in Fibonacci on a daily chart, then that would be my price range. But I just gave you an example. I started out with my example on the 1 hour chart. So day traders, for people who are day trading, people who are looking at getting in and out of the market fast, you want to use the Fibonacci on a lower time frame, like a 1 hour, 2 hour, maybe even a 4 hour. For what we're doing, options trading, you want to look at the daily and the 4 hour. All right. If I'm on the daily chart, I'm looking at the previous swing low all the way to the previous swing high, pull back all the way down. If I believe the pullback is complete, I can use the candles to verify that. Even though I have a pattern here, the pattern could continue to go all the way down to the 50% level and beyond. But for some reason, I think that there's going to be a breakout because I have an earnings call right here. My earnings date is on the 18th. I feel like it's going to break out of this to the upside. If I wanted to believe in Fibonacci and go off of my Fibonacci measurements, then my exit would be at the 100% level, which is around $153. $153 on the options profit calculator would put me at around 986 all the way down to $856 profit. And then my stop loss could even be, down here around 142, which to me, I feel like that's a little bit too much for me to handle. But 142 will put you at around $502 in the negative if you hold it for that long. All right. Everybody got that? Do you need me to do another example?
No, I got it.
You could do another one.
All right, cool.
Yeah, could you do one more?
All right, cool. So let's do, what else I got? I got Dropbox. All right, so let's do Dropbox.
Hey, Mills, why not put the expiration date like further out instead of like less than 2 weeks?
I mean, you can. You're just going to pay more money.
Okay.
So the longer your expiration date is, the more money you're going to spend. You know what I'm saying? Because it's more value in the contract according to how long the expiration date is. So the farther you go out, the more money you're going to spend. So I try to keep it even, giving me a good amount of value and a good length of time by going a week after the earnings call instead of actually on that week of earnings call. You know what I'm saying?
Got it.
So it's a little bit, I guess, bang for your buck, I guess you could say. So let's use Dropbox, for example. We can go back to the Dropbox. So let's say, for instance, all right, so my strike price was 24.5. Okay. And pull up my contract on Dropbox. All right, here's my contract on Dropbox. Okay. So on Dropbox, we have a Fibonacci sequence right in front of us. Can everybody see that is a clear fit on the Fibonacci extension? Everybody can see that, right? Hopefully y'all can see that. We're gonna go from swing low to swing high. All right, swing low to swing high. Now, if I was on this a couple weeks ago, I would have been watching it and I would have been ready to get in right here, 38.2% level. But I didn't do that. So what I'm looking at now is I'm looking at putting mine on here. Swing low, swing high, okay? Swing low to swing high, all right? And we're using the candles on this one. So swing low to swing high. You see the retracement. Now, last week, I kept saying, we're waiting for the pullback, waiting for the pullback to complete. We're waiting for the pullback to complete, right? We can scroll down to the 4 hour, and I told y'all, hey, look at Dropbox. It looked like it hit its floor on the retracement, right? Y'all remember that? You can scroll up in the
Yes,
Telegram.
sir. I remember that.
Yeah, you can scroll up in the Telegram and it'll tell you. All right. Here's my Dropbox. All right, so my entry on Dropbox is right here. Target price, previous high, stop loss, somewhere around this range to give me a good ratio. All right. Risk to reward ratio right here, 2:2. That's perfect. That's great. Anywhere within a 2-to-1 ratio is good for you if you're using this this measurement tool right here. Okay. So that's my entry. All right. So now we can go to the options profit calculator. 2573. 2573 will put me somewhere in this range right here. Okay. Earnings call is on the 18th. My expiration date is on the 26th. So I don't plan on holding this thing past the 18th. So it's going to give me, if I hold it until the 18th, then I might be happy walking away with $69 or 48, between $48 to $69 profit. If it reaches this 100% level, that's cool. That's cool with me. I didn't put that much money in. I don't, you know what I'm saying? That's fine. No problem. That's if I hold it all the way into the 18th. We got some time left. So Tuesday, Wednesday, it's already on the uptrend. It might hit this point before that point. We don't know. But if it reaches that point before, my profit is going to be more. You feel what I'm saying? Now my stop loss might be at like 23.9 or lower. I think my stop loss is probably like 24.13, something like that, right at the 38.2 level. So if you look at 24, what's that? 24.13, pull it up on this. 24.13 puts me somewhere around this range right here. Again, I'm not holding it past February 18th. So the most money that I'm going to lose is $219 if price goes against me. If price goes against me and price goes all the way down to $24.13, I'm getting out of the trade. I'm walking away with my losses. All right. My stop loss is right here. Okay. So now, everybody follow that? Y'all follow that?
Roger that.
Yeah, I'm following.
All right, cool. So let's review one more time. All right. So boom. This is where we at on Dropbox right now. My entry was here. Okay. I'm looking at the Fibonacci tool. I pull up the Fibonacci retracement. I go from swing low to swing high. All right. Price retraced all the way down to the 50% level, coincidentally, all the way down to the 50% level and started to work its way back up. If I was if I didn't come in so early, this 38.2% level would have been a better entry point. Would have been a better strike price. Then I would have had my stop loss here and my take profit here. But, you know, I came in earlier than probably I should have. All right, my entry was here. Take profit here. Stop loss here, around this area. 20, 24, 13, whatever the case may be. Around this area somewhere. Okay, take profit here, take profit here. I can mark it on my chart. All right, let me know where I'm at. So all I gotta do is watch the price. If the price hits my target, boom, perfect Fibonacci sequence. If price goes against me, boom, I know that I'm getting out right here at the 38.2 level. I'm getting out. All right, so that's how you use the Fibonacci tool to judge your entries, your exits, your stop loss, your take profit, and all the above. All right. So yeah, a better entry would have been here, but I came in earlier. I got my contract earlier, and I came in right around here. So price actually I could have sold right here, but you know, price went against me. But then I was waiting for the retracement to finish. If I didn't use the Fibonacci tool on this trade, but if I did use it, I would have been in a better situation. I would have been in a better situation because I would have came in right here, had my stop loss here, my take profit here. I'd have been making money already. But I didn't use the Fibonacci on this one. So again, I don't use it every time. But you know, for beginners, maybe y'all should. Maybe y'all should make it a point to use the Fibonacci retracement tool just to make sure that you are measuring the market right, you got your stop loss right, you take profit right, you're finding a good entry point, all that stuff. Go ahead. Simone, you had a question?
Yeah, my question was, when you put the Fibonacci on there, the little blue and red box, what is that? Is that a part of the Fibonacci? So when you do this, the low to high, and then the little red and blue that pop up when you say where your target price is, and you were able to expand it, that other little box.
Yeah, so that is, if you go into the left side of your trading view, that is your position. Okay, so look.
Oh, so I need to select position.
So look, that was a long position.
Okay.
So you click long position, and then you can go on the chart and select where your entry is going to be. So my entry is right here at my strike price. I literally click it, and it opens up that box.
Okay, that's what I was
can
missing.
extend
Okay.
it, and you see the price target at the top, stop loss at the bottom. I adjust it, and look, you got your risk and reward right here. And if you was on the second the call last week, what you gotta do, you can double click it or right click it. If you have your paper trading open on TradingView, it'll actually give you the price measurements. And you can paper trade on TradingView and play around with that if you want to play around with your paper trading on TradingView.
Okay, cool. That's what I was wondering.
Okay. No problem. Anybody else got questions?
I got a question. The Fibonacci is more suitable for like option trading, not really day trading, right?
No, it's perfect for option trading and perfect for day trading. Day traders use it. I use Fibonacci, you know, because if I pull up the Forex chart, right? So if I pull up the Forex and show you
the boneless.
Hold on one second.
Something there.
All right, so if I pull up the Forex right here, I can show you, you know, it's even easier on Forex because the candles look so much cleaner on Forex. But yeah, in this particular instance, you know, I day trade Forex.
Okay.
So swing high, swing low. I'm waiting on the pullback. You know, I wouldn't use it on this one because I don't know if the pullback is gonna start yet. But I can go back. Boom. Here's a perfect example. Swing low. It's a swing high. Pull back. Boom. Pulled all the way back to the 50% level. I would have got in here and had my target here, but I would have got stopped out. Price came all the way back down to the 7-8. You know what I'm saying?
So you always get in at the 50% level or the 32% level.
I like to get in at the 50% level because it gives me a good risk to reward ratio. That's just me. Some people like getting in. Some people like getting in at the 23% level, 38% level, 61.8% level, 7.8. It's up to you, to be honest.
Okay.
It's really up to you, you know. It's really up to you. But for me, I know that price usually, if it comes down to the 50% level and I start seeing blue candles, then I know that it's going back up. You know what I mean? Again, is the market gonna do what the market gonna do? All I can do is say is prediction, depending on what currency pair or what stock or whatever you're trading. If you're familiar with it and you understand how the price moves with that particular stock, then you have to judge the Fibonacci according to that particular stock or pair or whatever you're looking at. You know what I mean? So on this one, you know, I would have looked at this and said, okay, boom, hit 50% level, I'm going in. My exit would have been here, stop loss would have been here, boom, I would have came out there smooth. I probably would have went to sleep and woke up the money on that.
Okay, appreciate you.
All right. Simone, you got a question?
No, you already got me.
Oh, okay, my bad.
Sorry.
Anybody else?
I got a question about the candles.
Yeah.
I'm trying to actually pull it up on my chart and it's not coming up. Did I pick the wrong? Is there a type? Hold on.
Hold on a second. Where did I just put my give me 1 second. I know I didn't just close that window. Give me 1 second. I gotta pull up my window real quick.
Okay.
Sure. All right, maybe I did close it. No problem. All right. Let's go chart layout options. All right, so you said you're looking for a candlestick. So you need to go up to the top. You see these symbols up here? You got the time frames, compare indicators.
Okay.
Are you there?
Yes.
All right, you need to click that and it'll be a drop-down menu and you can select which ones you want. So you got the line chart here, candle here.
Hold on a second. I'm in the one that says indicators and strategies, and then it says candlestick patterns. Is that the same thing? Because I don't see like a drop for.
Does your trading view look like mine?
It does. I don't see that candlestick symbol though at the top next to where the M is.
Let me make sure you got the right. Hold on 1 second. Let me make sure you got the right window. All right, so DBX. Make sure you got the right thing going. Because sometimes when people get first started, they're looking at this right here. Do you see? Does yours look like this, or does it look like the other one?
It looks like the other one. I just don't see that candle drop option. I don't have that symbol right there. I don't have that up.
You don't have that up.
No. Oh, okay. Wait. Because it's on area. Okay. Now I see candles. Okay. Now I got it.
You good?
Yeah, I'm good now. Thank you.
All right, no problem.
All right, bye.
Anybody else got questions? All right, so let's go ahead and I got a few more. Let me see how many slides I got on this one. All right, Fumo. So I just basically broke down Fibonacci and how to use it. So we can go through that. So my man asked about the 50%. The 50% retracement level is not really a Fibonacci ratio. However, traders often use it because of the tendency of asset prices to continue in a particular direction after a 50% retracement. So basically what it's saying is if the price is in an uptrend and it starts to retrace, very often you'll find that if you're using the Fibonacci tool, price will drop all the way down around the 50% level and start working its way back up and continuing on the uptrend. So that's why I said 50% level. If it happens to reach that point, then you know that, okay, that's another level of confluence. I can enter here, set my stop loss at 68.3 or whatever, and then have my take profit at 100% and watch my money get made. You know, that's how a lot of people look at it. Pros and cons. Despite the popularity of Fibonacci retracements, the tools have some conceptual and technical disadvantages that traders should be aware of when using them. The use of the Fibonacci retracement is subjective. Traders may use this technical indicator in different ways. Those traders who make profits using Fibonacci retracements verify its effectiveness. At the same time, those who lose money say it's unreliable. Others argue that technical analysis is a case of a self-fulfilling prophecy. If traders are all watching and using the same Fibonacci ratios or other technical indicators, the price action may reflect that fact. So basically what that's saying is, if everybody is using Fibonacci, then the price is going to reflect that way. So if there's a large majority of people using the Fibonacci retracement tools, then they're setting their stop losses and they're setting their take profits, everybody's operating at the same level, then that just makes it even easier for you to make money. And that's why a lot of people like it, because it's like, well, if everybody using it, then it's going to work. So what I do is I combine the Fibonacci and the pivot points, because if you study pivot points, you know that pivot points are used by the floor traders on Wall Street. Those combination of numbers, that formula and all that stuff, they use that. You know what I'm saying? The floor traders on Wall Street use the pivot points. If you're a Forex trader or you're trading the market and you look at different platforms that you can get your news from, they'll actually show you the pivot point measurements and the price points on those particular platforms. They wouldn't put that there for no reason. So people actually use them and rely on them. So if I look up, if I'm on a 4-hour chart and I look up the weekly pivot points, right? I'll look at the weekly pivot points, and then I'll take the Fibonacci tool and I go from swing low to swing high. The pivot point is pretty much giving me the same entry that I already have. Do y'all see that? Y'all see that? I put the fib on here, swing low to swing high, and the pivot point is right here. Let me change the color so y'all can see. Let's make it yellow, or let's make it red. Let's make it white. All right, cool. Now I'll make it thicker. So boom. So my pivot point is really like right around my strike price. So I got pivot point, strike price, Fibonacci level, all at the same range. Support level, right around the same range as my stop loss. And my take profit, well, my previous take profit could have been right here at the resistance level of last week, but this one was up here. So that's, you know, that's a Fibonacci extension level. Fibonacci extension level might be up here, but I could put my take profit right here. I could put my take profit right here, but you can see that all this stuff is starting to add up. So I got my Fibonacci showing me a good entry here. I got my pivot level showing me a good entry here. And then my take profit and my 100% level is all here. This when all this stuff starts adding up, that just let me know that I'm on the right side of the market, and I'm probably gonna end up making some money off of this. All right, so that's how you can pretty much put all that stuff together. If I give another example and use Walmart, we could see if Walmart is giving me the same type of look. So I know it's a lot of stuff on here, but y'all gotta get used to this. I mean, it just is what it is. If I pull out the fib and I go from swing low, I go to swing low to swing high on the fib. My pivot point happens to be at the 38.2% level on the pullback. This could be a good entry point if price actually reached this point, but I could have came in right here, and I could have had a take profit up right here, or take profit up right here. But as you can see, you know, a lot of times this stuff will give you everything. Now I could be looking at the market the wrong way. I could look at it from a bearish perspective and go swing high, swing low, swing high to swing low. You know what I mean? This would have been the retracement level all the way down to 78.2. The pivot here could have been giving me a short entry at the 50% level. Short entry, exit down here if I was bearish on Walmart. You see how that works? So if I was bearish on Walmart, I would have went from swing high to swing low. My 50% level happened to be right smack on top of the 50% on the pivot. The pivot and the 50% are right on top of each other. If I was bearish on Walmart, I would have waited until price hit the 50% level and I would have entered for a short entry, and my target price would have been down here at $139.12. It just depends on how I see the market. If I have a bearish outlook on it, then that would have been my entry. If I have a bullish outlook on it, then it would have been the opposite way. Y'all understand that? So the key to all of this is being on the right side of the market. All right. Now, obviously, I wouldn't have used that small of a time frame on the fib. I'm using the bigger time frame on the fib. I'm looking at it from here to here. You know what I mean? And yeah, it did go below the 7.8, but it bounced up. And I'm looking at it from a bullish perspective because I'm using the earnings call and I'm looking at the previous 3 months. They're in profit. They're predicted to beat earnings. So I'm looking at it from a bullish sense, and I'm looking at a target up here. All right. So it all depends on your outlook on the market and what you see, how you measure it, what your prediction is, and then you can always use those pivot points to give you a good range. Now, maybe if I'm on a higher time frame, maybe it's more beneficial for me to use a monthly pivot instead of the weekly. It really just depends on my expiration date. All right, let's see what the fib is telling us. Swing low, swing high. Okay. Not really telling us much because it's on the downtrend. But if I really wanted this thing to go bullish, then 50% level here, an entry on its way up. But you know, I'm already in it, so I'm just hoping and praying that I'm not wrong. All right. Let's see. All right, so just to finish up, so furthermore, Fibonacci retracement strategy can only point to possible corrections, reversals, and counter trend bounces. This system struggles to confirm any other indicator and doesn't provide easily identifiable strong or weak signals. So it's not going to tell you if the signal is, it's not going to tell you if the volume is good, is strong or not. It's not going to tell you everything. It's just going to measure the move in the price. All right. That's really all it's going to do. Bottom line, Fibonacci trading tools suffer from the same problems as other universal trading strategies, such as the Elliott wave theory. That said, many traders find success using Fibonacci ratios and retracements to place transactions within long-term price trends. Fibonacci retracements can become even more powerful when used in conjunction with other indicators or technical signals. All right. So what I do is I use the Fibonacci with the pivot points, and I also use the Fibonacci with my indicators that you see here on the bottom of my chart. All right. So at the bottom of my chart, I have my RSI and I have my stochastic. For those of y'all who don't know what these two indicators are, I'm not going to pull up a huge PowerPoint for it, but I do have a brief description, so you at least know what the RSI is. All right, so the RSI, Relative Strength Index, all right, invented by Jack D. Swagger, a board member of the fund Cedar and author of several books on technical analysis, uses the term normalized to describe stochastic oscillators that we have predetermined boundaries, both on the high and low sides. An example of such an oscillator is the Relative Strength Index, a popular momentum indicator used in technical analysis, which has a range of 0 to 100. It is usually set at either the 20 to 80 range or the 30 to 70 range. Whether you're looking at a sector or an individual issue, it can be very beneficial to use stochastics and the RSI in conjunction with each other. So basically what I do is I use the stochastic and the RSI in conjunction with each other. So my stochastic, basically what I use that for is to judge price momentum, okay? Price momentum. So as you see, it goes up, it goes down, it goes up, it goes down. All right, the 100% level is all the way up here, and then it goes all the way down here, okay? So what this means is, as you can see, when price gets outside of this little purple area right here, and it goes up, that would be considered overbought territory. Means price is extended farther than it should be, basically. And it's possibly gonna retrace down. When it starts pointing down, some technical traders use this as a sell entry point. But again, all these indicators are lagging indicators. So if you depend on this, you're gonna end up being a little late. But some traders actually use this as a sell entry. Same thing if I'm looking at it from this perspective. Once it goes beyond this range and it starts pointing up, and that's oversold. So we're looking for it to come back up. Some people would use this as a point to come in as a long entry, all right? As you can see, as I'm hovering over this range right here, all of this stuff is in confluence with the actual price. So let's just say that I did use this as an entry point and I came in when I saw it was pointing up. I would have made money if I depended on this indicator. But I don't depend on this indicator as a buy or sell signal. A lot of people do, but I don't. You know what I'm saying? So I use this to let me know whether I should be getting in or I should be getting out. I don't necessarily use it as an entry, but I use it to judge whether I think a pullback is coming or not. All right. So when I got into this particular Walmart trade, I got in right here, okay? And I look at my stochastic and I see that it's overbought. So there's no surprise to me that price is going back down. But if price starts to come back up, then I know that I'm in a good territory. Just because it's pointing down doesn't mean it's going to drop all the way down. As you can see, sometimes price starts pointing down and then it comes right back up, starts going down and then it comes back up. You feel what I'm saying? So that doesn't necessarily mean it's going to go down. As you can see down here, price pointed down and it stopped and it came right back up. So it doesn't just because it's pointing down don't mean it's going to drop all the way down. It's just a judge of momentum. All right. For what the RSI, it's also momentum, but what I use the RSI for usually is for divergence. So divergence is when stuff doesn't add up. All this stuff needs to be adding up. So if this is pointing down and this is pointing down and price is pointing down, then that lets me know that everything is smooth, everything is going the way it should be. But if price is going down and this is going up and price is going down, then something ain't right. So when I look at the RSI, I'm looking to see if this movement equals this movement. If at any point I see that the movement on the RSI does not reflect the movement up here, then I call that divergence and I'm starting to look for a potential short entry or a long entry. Let's see if I can find an example. I'm looking. everything on here looks like it's moving the way it should be. If I scroll back, let's see if I can find something. Okay. Boom, 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 boom. Don't see anything here. Let's look at another one. All right. That's the only reason why I use the RSI. All right. And some of y'all are starting to see that. If you put the RSI on your chart, all you gotta do is go to indicators and then type in relative strength index. Relative strength index. You see relative strength index, you click on it, it'll pop up on your screen, and then you can adjust the colors however you want to adjust them. All right. Right now I'm looking for a potential, is that one? No, that's not it. There's gonna be one on here somewhere. Is that one? High point. Okay. All right. So let's see if this adds up. Nah, I wouldn't use that. One here. High, low. High here. High here. All right, so that makes sense. High here, low here. Okay. And then high here, high here, high here, high here. So all this stuff adds up good. I'm trying to find something here to where it's clear, like, oh, this is definitely about to be a move coming up. High here and a high here. All right, so boom, this is clear. All right, this is just an example. Y'all don't have to get deep into this, right? So this is what I do, okay? So look, you see this high point right here, right? I got a high point right here, okay? And then I got another high point right here. Both of these high points on the chart. Make sure y'all. And this is something that could get y'all easy money. So these are two high points right here. Now I look at the RSI. The RSI here is higher on this peak than it is on this peak. If I put a trend line on this, the trend line will make it even easier to see that it's leaning. You see what I'm saying? It's leaning. So this point on the RSI is higher than this point, but on the chart, this point is higher. I mean, this point is lower than this point. So what does that tell me? If I'm going off of the RSI is telling me that it's about to be a downtrend. It's about to be a downtrend because the momentum is going down, even though the price is going up. So I can pretty much bank that after this peak, it's going to be a drop. So when I saw that there was a divergence between price and the RSI, then I'm looking for a sell entry. All right, that's an easy trick for y'all to look at. So if you put the RSI on your chart, the only reason why I'm using the RSI is I'm looking for divergence, a difference between the price movement and the actual momentum of the RSI. You saw this point was higher on the RSI than this point, but this point was lower on the chart than this point. So what that told me was, even though price is moving up, it's about to be a big retracement because the RSI is telling me that momentum is already going down. So I would have came in right here for a short entry and I would have made money based off of using this RSI strategy. All right. And then when I'm using the stochastic, all I'm looking at is momentum. So momentum on the stochastic let me know that it's already in overbought territory anyway. So it's going to come down anyway. So boom, that's another layer of confluence. So I got 1 layer, 2 layer, 3 layers of confluence without using the fib, without using nothing else, letting me know that it's about to be a downward movement. I could have came in at a long short entry, and my take profit might have been the 50 moving average. That would have been a good test. I think price might test the 50 moving average because the momentum is already shifting. It's going to be down, so maybe my take profit will be here. I would have got out of this trade. I would have been in. I would have got in right here, I would have got out right here. Boom. Easy money. All right. Everybody understand that? Everybody understand that?
Yep.
Yeah, I understand that.
Yes, sir.
Yeah.
All right, cool. I have a PowerPoint for moving average. I know we're coming on a 3-hour mark. I'm pretty sure everybody should pretty much know what the moving averages are. I think I went over it already, but we can just go through it real quick. Moving averages. So everybody should pretty much have the moving averages on your chart. If you look at CSNBC and all these other Yahoo Finance, whatever news channel you're looking at, they always use moving averages. If you pull up Yahoo Finance, Yahoo Finance will let you know what the moving averages are for a specific stock. What was looking at? I was looking at DBX, Dropbox. It'll tell you if you go to analysis. It usually will tell you, maybe not on analysis. The statistics, profile, financials, maybe statistics. Yeah, so if you go to statistics, it'll tell you what the moving average, 50 moving average price is here, 200-day moving average here. So everybody uses this stuff. So it makes no difference. Like it makes no point. It makes no sense for you not to use what the financial guys are using. So, definitely put some moving averages on your chart. I use the 50 and the 200. When the 50 and the 200 cross, I'll explain that. Everybody should pretty much know what that means. All right. So just to go through it real quick, in statistics, a moving average is a calculation used to analyze the data points by creating a series of averages of different subsets of full data set. In finance, a moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. So it's basically the average price over a specific time frame. All right. A moving average is a stock indicator that is commonly used in technical analysis, blah, blah, blah. So a simple moving average is a calculation that takes the arithmetic mean of a given set of prices over the specific number of days in the past. For example, over the previous 15 days, 30 days, 100, or 200 days. Exponential average is a weighted average that gives greater importance to the price of a stock on more recent days, making it an indicator that is more responsive to new information. So when you put an EMA on your chart, it's going to have a little bit more movement than a simple moving average or a regular moving average. So you can choose any of these. Again, if you looked at my chart, you saw a moving average and a simple moving average or a smooth moving average. But you can put an EMA on yours if you want to. All right. It's a lagging indicator. All right. So I wouldn't base my entries off of it because it's a lagging indicator. So if you're waiting for a cross, then you're gonna miss a lot of your profits if you're waiting on that. All right. This basically breaks down the days. A rising moving average indicates that security is an uptrend, while declining moving average indicates that it's a downtrend. Similarly, upward momentum is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a longer-term moving average. Conversely, a downward momentum is confirmed with a bearish crossover, which occurs when a short-term moving average crosses below a longer-term moving average. So when I talk about that 50-200 cross, when the 50 moving average crosses above the 200, we're in the buyer's market. When the 50 moving average crosses below the 200, we're in the seller's market. That's basically what we're talking about. All right. And then 26 days. Yeah, so this is all stuff that we should pretty much know. Okay. I already went through this. I just wanted to pull up the PowerPoint to make sure we're not missing nothing. And we all should know the differences. These are all the numbers. All right. I'll plug this PowerPoint into the class. So if y'all want to go through it, y'all can go through it and look at it. But I basically broke all this stuff down for y'all already. So everybody should pretty much know what the moving averages are. Okay. and why we use them. So we use them to let us know what side of the market we're on. All right. Just to make sure we're on the right side of the market. Again, you know, when the 50 is above the 200, buyer's market. All right. When the 50 is below the 200, seller's market. We're looking for sell entries. Okay. And that's pretty much it. Anybody got any questions?
Yeah, I have a question.
Go ahead.
How do you add those to the to your chart?
All right. So are you? Does your chart look like mine right now?
Yeah, it does.
All right. So you want to go up to the top and you see F. You see that little F with the indicators.
Mm-hmm.
You click on that, and then you just type in moving averages. All right. And then you want to scroll down until you see the basic joint. So I got simple on mine, and I also have the smooth moving averages. All right. You don't have to use those. If you just want to keep it simple, where's the regular one? Hold on 1 second. It just popped up. Let me go to MA. All right, boom. So just type in MA. MA, boom. So you see moving averages should be the first thing to pop up.
Yep.
All right, just click it. And then you can adjust the color and adjust the time frame. So you want to have at least 2 on your chart. So what I do is I put my moving average at 200. And if you want to throw another one on there at a different color, you could put it at 50. All right, so that's a 50-day range and a 200-day range. If you wanted to take the other examples that we talk about, exponential, you put EMA. EMA, moving average exponential, there you go. If you want to do SMA, smooth moving average is what I have on my 50, there you go. All right. Simple moving average, type in simple moving average, there you go. All right. Weighted moving average, type in weighted, moving average weighted, boom, there you go. And you could just play around with them to see which one best fits you. I'll just keep it simple. I use a smooth and I use a regular moving average. My smooth moving average is the smaller time frame, which is 50. And then the bigger time frame is the regular moving average, which is 200. You good?
Yep. Appreciate it.
No problem. Anybody else got questions?
You said 50 above 200 is a buyer's market, right?
Yep.
Okay. And what's the seller's market number again?
Well, you're in the seller's market if the 50 moving average has crossed below the 200. So if you look at this example, all this down here would be seller's market. So my green line is my 50. My blue line is my 200. So my 50 crossed to the downside, boom, all this is a seller's market. So I'd have been, so through all throughout this period of time, I would have been looking for sell entries. I would have got in here, we got in here, here, here. And then once price crossed over and pulled the 50 moving average up with it, now we back into an uptrend. All right. So for y'all long-term stockholders, you want to look at the higher time frame and you want to see where the cross is at. So when you see that cross, that would be a good entry for you to go for a long period of time. All right.
What's the indicator again? The blue and the green indicators, I forgot.
Moving averages.
Moving average, okay.
Yeah.
Gotcha.
Anybody else?
Yeah, I have a question.
All right, go ahead.
With the in the beginning when you were doing the patterns on the charts with the trend line, like, could you go back over like how to use those trend lines to identify those patterns, all the different patterns?
All right, boom. So this is the daily chart right here, right? So clear trend right here. You would just pull up the trend line, click the trend line, and you would start at the low. and you would connect it at another low point. So you need at least 2 low points. And that's your trend right there. You can use the moving averages as the trend indicator. So you see the moving averages moving up, but you can take that trend line right here and use that. So now sometimes when price starts going down, some people use the trend line as a judge on whether price is going to turn around or not. So if price comes all the way down and bounces off and goes back up, now you know your trend line is accurate and is being respected. So that could be an entry point for you to go long on the way up. But that's how you do it. You have to connect 2 points. Same thing on the downtrend. On the downtrend, you want to connect 2 points. So 2 points will be here and here, or here and here. It has to be two points, depending on your strategy. So if we're going to use the moving averages and whatnot, then that would be my 2 connecting points. Respected it here, and then it went down, then it crossed over, then it came back down. So, you know, that's pretty much how you use the trimmer. All right, I'll go into detail with that later on in the week, but you just got to play around with, boom, 2 right here. You see price low, respected it here, boom. You see my Walmart example. All right, the Walmart example I had, my trend lines get respected. Here, here, respected. Here, respected. All right. So I'll do a little example on that probably tomorrow. And I'll upload that and send the link into the Telegram group. But I gotta get up out of here, man. We're going on 3 hours now.
All right, thank you.
Yep. I appreciate y'all.
All right, have a good one.
All right. Any more questions? Go ahead, type it into the Telegram, and I'll get you straight in the Telegram group. Appreciate y'all. Y'all have a good evening. Peace.
Appreciate you. Thanks.